Good morning. It was Sunday, December 11th. What a great song. It's funny just looking at the lyrics here. How appropriate. So, okay, you get up every morning, your alarm clock's warning. Here we go. Okay, so here we go. This, I think, applies to maybe too many folks on FinTwit. If you ever get annoyed, look at me. I'm self-employed. I love to work at nothing all day. If it were easy as fishing, you could be a musician. If it was easy as fishing, you could be a stock market speculator. Anyway, these are great lyrics. I got to tweet these out. All right, so here we are, Sunday the 11th. This date in history, we got to get Roque in here. I'm going to get him, ask him to come up and speak. So, 1941, Hitler and Mussolini declare war on the United States. 1961 marked the first direct military involvement of the United States in Vietnam. And Roque, maybe you were at this game, or maybe your father was at this game. But in 1938, in the NFL championship at the Polo Grounds, the New York Football Giants beat the Green Bay Packers 23-17. There was a record title game attendance of 48,120. So, John, I don't think I never went to the Polo Grounds. I suspect you weren't old enough either to go to the Polo Grounds, but maybe you could chime in, if not with some market observations, maybe what you know about the Polo Grounds from your father or from others. What a great field that was. All right, why are we doing this space? We did a couple spaces last week, normal spaces. We had a great space with Arjun Murdy. And then we had another great space with Michael Howe. One of the all-time best spaces ever with Michael. I urge everyone to go back and listen to that replay. It was great that he had some charts for us as well. Friday, I was triggered by the price action. I wasn't going to do a space. I'm doing a space this morning because I am triggered. And John, just so you, while we're warming it up, you can throw in a couple comments here. I was so offended. John, you have spoken about the cost of pizza on Arthur Avenue in some of your missives. I was so triggered. People want to know the title for this room, where it came from. So I'm going out of town later this week. Yes, I'm going to take a vacation. And so, I live in Westchester. And by the way, one of the things I want everyone in this room to chime in with, even those you haven't spoken up before, anyone who has an example of offensive predatory pricing behavior, that's what I should change the name of this room to. I want to hear it. I want you to bring it. I was so offended. So, supposed to go to JFK. It's a 45-minute ride. I figure, how much can it be? So, we do Uber. Uber, they wanted I don't know. It was $95 or something like that. And we're trying to figure out, doing the ARB, not risk ARB or stat ARB, but do we park or drive ARB? By the way, you want to go park at LaGuardia? It's unbelievable. I'm going to JFK. I went to LaGuardia about a month ago. The daily parking rate, call me a cheapskate or whatever, I just find it's against my religion. And even though John is Catholic and I'm Jewish, it's against his religion too. It's against my religion to pay $75 a day for parking. So instead, I'm a cheapskate. I go in the long-term parking lot at LaGuardia. It was $29. All right, fine. That's a win, $29. Compared to Boston, it was. We're used to it. It was like $40. So anyway, I'm going to JFK. And the Uber, they wanted $95. I'm like, that's ridiculous. This is to go at 6 o'clock in the morning. So we go on Lyft. That's why you have to have competition. Lyft is $68. I'm like, sold to you. They're going to come at 5:45 a.m. on Thursday. So there'll be no space at 5:45 a.m. on Thursday. $68. I'm happy at $68. What is the world coming to? I'm happy it's only $68. Neely, you're going to have to speak up because it has to do with the consumer. All right, now we got to worry about coming back. I'm coming back on a Friday night, 8 days later. Of course, they're going to sock it to you with surge pricing. 10 p.m. pickup, JFK. What do you think? I put it in an Uber. They wanted, $90, $95 going. They want $120 coming back. I'm like, are you kidding me? It's going to cost almost as much to take the limousine as it will for the plane ride. Like, what is going on here? So I said, enough. I figure I'll call limousine service. I'm a cheapskate. So first I go on Groupon. I get all confused. There's too much of this, too much of that. I'm in Westchester. They're giving me the price of rides to go to the Miami airport, or I don't care. I want here. So then I call up. I go a couple of the car ride services, some of the best known, presumably reasonably priced. 45-minute ride. You thought $120 was bad. $220. It's not a typo. 220. I called 3 places. They all collude. 208, 220, 208, 212. Someone's got Jerome Powell's number that can tell me when these prices are going to go back down. Oh, by the way, my girlfriend says, oh, but you know the price of gasoline has gone down lately. I say, yeah, I know. They're not cutting the price of the rides. This is just outrageous. And what people, and there's a serious point here, and that is everyone's so fixated on rate of change and blah, blah, blah. Someone tweeted out not too long ago, and I recycled it. People live on price levels, not on rate of change. Specifically, as the great Vincent Deluard said, and I urge you to please, please, please go listen to the space he did with us a month ago. I heard him again this past week at the StoneX conference. There's a shortage of people who stand on their feet for a living in this country. Those are the people who have bargaining power. As we discussed a week or two ago, BlackRock in the most recent update talked about how, I think the second largest or one of the 5 largest employers in the country with like 625,000 employees. They had fired a whole bunch of people at the beginning of the pandemic that were making $12.50 an hour. They subsequently rehired them, I think, at $19 an hour. I think wage increases are like 8% this year. They're looking at 6 to 8% for next year. Again, I'm not interested in accuracy, not precision. And the point is, if you have a tight labor market and you've lost a lot of your purchasing power, it's time to play catch-up football. And your labor, and you, for the first time in a million years, you got pricing power. You're gonna get those higher wage gains. So do I really care that the monthly CPI in the month of October was only 0.2, revised up to 0.3, because the healthcare and insurance calculation got changed by 0.4%? Are you kidding me? Wage gains are here, and they're not going away. The most recent data shows the persistence of high wage gains. The ratio of job offers to applicants is still very high. So I don't care about used car prices. Wage gains, and again, inflation is a process. It's not an event. Wage gains are going to remain persistent, and therefore, I think it sets the groundwork for a big profits and margin squeeze. We're starting to see it. I don't want to get into an IQ contest debate about, the GDP. No. We're here about asset prices. Stocks are a function of multiples and earnings. And Kantrowitz, who happily came in the room the other day, reiterated, the Piper sub $200 S&P earnings estimate for 2023, being echoed by the likes of Deutsche Bank, Michael Wilson, even Goldman Sachs, they're cheerleaders. With the S&P at 3,900, and if we ever do get a credit cycle, and God knows how we get a recession, how the market bottoms here is insanity. It's a pipe dream. All right, so listen, I'm on a rant. I'm reliably told I talk too much, but then on the other hand, I get a lot of DMs. People say they like when I rant, so here we go. I'm going to stop. And with all that, we have the great John Roque of 22V. When John speaks, I listen. Does fabulous work. John, it's a privilege. It's really great that you share your wisdom with those of us here on Twitter. Also, albeit in a very colorful way, with a lot of references to sports, celebrities, etc. So maybe, I don't know if you want to start in with a lead-in about the 1938 NFL title game, or any thoughts about the Polo Grounds. I know the Polo Grounds suck compared to Yankee Stadium, but in any event, John, the floor is yours. So take it away, John. Good to see you, man.
George, thanks for having me here, and thanks for that over-the-top introduction. So my father was born 1929, so he didn't see the 38 championship game, but he did often go to the Polo Grounds, and he did remark to me how you could see the lights on in Yankee Stadium for a night game when you were sitting in the Polo Grounds watching a night game there. Of course, because it was just across the river. He was also a New York Giants baseball fan, a New York Giants football fan, but he is very fond of telling me that he took my mother to see Gale Sayers play a preseason game at Yankee Stadium against the Giants. And I said to him, "How was he?" He just said in one word, "He was just electric. You couldn't take your eyes off of him." So he's seen a lot, but he's not old enough to have seen the 38 championship game. But thanks for the heads up on that. I'll tell him about it later.
Terrific, John. So turning to things more relevant, I don't know if you want to go with the update of the egg and cheese sandwich at the whatchamacallit, the breakfast places, or the Arthur Avenue pizza price indicator. But what can you tell us about real world inflation? What's going on in the real world, John?
Well, George, it's been my take. This happened in the spring of 2021 when the Fed first got on the transitory bandwagon. I thought that they were going to be totally wrong. It was a lucky idea of mine, but I thought that they were going to be totally wrong. And all I did at the time was I just went back and counted how many months in a row, the PPI, first I started with the PPI, had been above 6% year on year. And so we are now into the third longest cycle ever. And I know the year on year number peaked at 18% some months ago, and now it's down to 10.6%. But there are a few things to consider. We're now 21 months in a row of greater than 6% year on year figures. That's the third longest streak in history. The two prior longest streaks happened in the early 70s until the kind of later 70s, and then again later 70s because it reversed it pretty quickly into the early 80s. But it took the Fed almost 9 years to get the inflation genie back in the bottle the last time figures were this high. And I also think that this is the following is especially true is that these prices are now embedded. There is no way that the pizza maker is going to lower the price of his slice, despite the fact that wheat might be less expensive for him. It's never happening. He's going to keep that price there.
Muhammad Ali or Cassius Clay, they're going to not. You're saying they're not going to reduce the price of the slice? Did I get that right?
Yeah, that was good. It was kind of like it was an Ali rhyme for him for which round he was going to knock his opponent out in. And then can I share a long ago story with you? I think it's still important.
Go for it.
When I was at Key Square employed a former Federal Reserve governor as a consultant. He would come down on a monthly basis. He taught at Harvard. He'd take Amtrak in, and he would sit in our offices all day long in a conference room, and everybody on the investment committee would go in and speak with him. He was a nice gentleman, and I didn't spend an hour with him because I didn't think that he could tell me what I had most questions about. And I had most questions about price action. But I would often talk to him about the Red Sox and the Celtics. So one day he came in for a day to spend with us, and I asked him if he wanted to go get a bacon, egg, and cheese around the corner on 60th Street. So we went downstairs, and when we were on the street on Madison and 60th, I said to him, "Can I ask you a question?" And he said, "Yeah." And I said to him, "How many civilians does a four-star general speak to in a week?" And he said, "I don't know, John." I said, "The answer is zero. The four-star general speaks to only people of like rank or slightly lower rank. He hardly ever speaks to soldiers. The only time he really does it is in a photo op. Otherwise, every minute of his day is scheduled. He has no time for civilians." I said to him, "How many civilians does a four-star general speak to in a year?" He said, "I don't know, John." I said, the answer is still zero. I said to him, "You're from New Jersey, aren't you?" He said, "Yeah." And then I said to him, "Well, then maybe you'll be able to answer this question. How many civilians does a mafia capo speak to in a week?" And he looked at me and he said, "How am I supposed to know that?" I said, "The answer is zero. He speaks to one guy on the street, a noisy street, whispers in his ear, no Instagram, no Pinterest, no texting, a burner phone, and he puts policy out. And if policy's not followed, you know what happens thereafter." Now, here's a question I think you're going to be able to answer. How many civilians does the Fed chair speak to in a week? And he said, "Now I get your point." The point is that it's very hard to understand what the person on the street is going through with respect to prices when you sit in the back seat of a Federal Reserve chauffeured town car, when you don't pump your own gas, and when you're feted weekly at different cocktail parties or Washington, D.C. events. The Fed has missed it because they're so far from the ground. And I think these prices are going to stay relatively sticky. And I think rates will stay relatively sticky, which to me says that it's going to be continue to be difficult for equity markets.
So, John, that's we oftentimes it's too easy to get caught up in anecdotes, but I think you hit the nail on the head with that one. That rings so true, I think, to everybody in this room. So let's speak to rates now for a second. Let's generalize or zoom out, as our Bitcoin maxi friends would say. You had the cojones. You have to remind with you. What's the Italian word for cojones, Josh? John, I forget.
Coglione?
Coglione. You have the coglione, okay, to call rates to 3 when they were like at 2. And then when they were nearing 3, you said 4. So victory lap. Let me know when you're done. Victory lap in order. You're entitled to catch your breath. I mean, let's call it like it is. Too many people take shots on Twitter, but they're not recognized when you got it right. You made such an out of consensus call, and it was so right. Okay. So we had the rocket ship move to where the 10-year went to 420, wherever it went to. It came off to 340 the other day. As I mentioned in the space on Friday, I was sitting listening to Vincent Deluard speak on Thursday, going on about why inflation is going to be sticky, speaking to specifically the fact that cheap labor, cheap energy, cheap goods are all things of the past. Those are the forces that gave us the great disinflation, and now they're all up and to the right. And so he thinks, the Fed will be lucky to get inflation down to 4 or 5. Maybe they'll do that by the spring and take a victory lap. And I sat there listening to all this. And then I saw some indicators that all read the same stuff, showing how, economic activity has come in, at or better than expected for the most part. Yes, housing is a disaster, but the rest of the economy is, doing okay. And more importantly, funnily enough, European data has been better than expected, largely because energy prices have come off. People are now getting amped up about China doing better or prospectively doing better because of the prospect of reopening. So I'm looking at all this and I'm saying, and I see the 10-year at 340. I'm like, well, wait a second. What are bond yields doing here at 340? So that all just sets the context. It's T-ball time, John, for you to update your views on rates from here. I mean, on a predatory tactical basis, I went in a shorter bonds on Friday. I think yields are going higher from here. But let's not get caught up on our narratives. One of the things I love about you do, John, is trade what you see, not what you think. How do the charts speak to you about the outlook for rates, both the 2-year and the 10-year?
Okay, so I think it is not the right spot to short, to be long 10-year treasuries here. I think rates are going to bounce. Both short-term momentum indicators that I follow are oversold, and the yield came down to, let's call it 3.5%, which was the last breakout level for yield that occurred in mid-September of 2022. So you had a retracement to the breakout level. So I think yields are going to bounce. I think all of us, will be able to tell on this bounce if yields are going to have enough chutzpah to be able to make new highs. And the reason I say that is because weekly momentum indicators for the 10-year yield have put in kind of, a little momentum peak, and the monthly momentum indicator for the 10-year yield is slowing. So I think that we're going to have a bounce here in 10-year yields, but I'm not necessarily certain it's going to be big enough to make a new high above where it was in October. But I think the yields will bounce here on support and oversold. If yields were a stock and the fundamental story was still intact for this stock, this is where you'd be looking to find some sort of a bounce for it.
Okay, so at least short run, yields are likely to go higher than lower, and then we'll check in. Details to follow in 11 o'clock news. We'll see how far this thing runs. But as you then look across asset classes, so that's the yield piece of it. And I see we got Michael Kramer in the room here too, who's a big macrophile, so we get Michael to chime in as well. But now that when you look at the dollar and also crude, and again, everyone needs to get down on their knees and pray to not Allah but to John. He nailed this freaking energy call as well. He's too modest. He doesn't take victory laps. I can say about his calls what he can't say. He was cautioning about crude and the stocks. John, what when you look at crude, this thing has no pulse. I mean, the crude chart needs some Viagra. It's just horrible. But what is so again? Maybe we're going to get different answers here. But What does crude look like to you, and what does the dollar look like to you?
Okay, so first I'll start with crude. I think that, and I'm going to use the CLZ3. That's the futures contract for 2023, December 2023. I'm going to use that price. I think that crude has risk to the low 60s, $60. And all of my momentum work has peaked and rolled, and it did it kind of, I'd say about 5 months or so ago. It was a very tough sell, or a very tough discussion to have with guys who are very bullish crude. And I will tell you, I was in London maybe 6 weeks or so ago, and I went there with the same kind of notion to say, I find it very difficult to believe that crude can go higher here, because everybody who's long crude is long for the exact same reasons. Is that the SPR had to be refilled and that China would open up. I said it's been rare in my career that everybody could be right for the exact same reasons, especially with momentum indicators weakening. So I thought that crude would be lower, and so it's held, I guess, at the 70-69 area based on this CLZ3 contract. But I think it's going to fail, and I think it's going to get to 60. And I think, and this is my imagination talking, I think what we're witnessing here, and this has been a pretty decent trade as well, because I went out on being long silver relative to oil, and that's worked pretty well. I think it will continue to work. Precious metals are improving relative to oil, and industrial metals are improving relative to oil. I do think, and this is again my imagination talking, that in 2023 we'll see metals prices do better and energy prices do poorly, kind of the opposite of what we saw in 2022. I am encouraged that gold is improving here, because I know that there is no historical record, at least the records that I keep, of a commodity-driven bull market without gold participating. So I'm glad that gold is participating. It could be that oil takes the year off. It had a big year. It actually had a big, almost 2 years from mid 2020 until mid 2022. So it might be that crude has a difficult time in 2023, but I'm encouraged by the action in gold and silver. And I'm waiting for the ags to pick up, but I certainly want to own precious, and I want to own industrial relative to crude. And then you asked about the dollar. I want to be long yen on any dollar yen bounce. I want to be long Sing dollar on any dollar Sing dollar bounce. I want to be long Thai baht on any dollar Thai baht bounce. And I want to be long won on any dollar Korean won bounce. The dollar's oversold on a daily basis, much like the 10-year is oversold. The dollar still has an upward sloping 200-day. It can bounce here, but I want to sell dollar yen. I want to sell dollar baht, sell dollar Sing dollar, and sell dollar Korean won on any bounce. I think the yen is going to do better, especially.
John, let's just turn to the market a little bit here.
Yep.
So you've made consistently, just to remind everyone in the room, you've been on this kick for a long while, favoring non-growth over growth. Please update your views on that. And then, so A, are you still a believer in non-growth over growth? B, out of that, what groups would you avoid? What would you buy? And then lastly, overall market call. I think, like myself, you'd be looking for much lower levels earlier. What's your overall market call? So take those in any order you choose.
Okay. All right. So I'm going to start with the S&P first. So the S&P had a big rally. I guess it was up about 17 or 18% over 35 days. It got just above its 200-day moving average, but that was still downward sloping. So my written comments were, don't chase anything into a downward sloping 200-day moving average, because we're still in a bear market. And I thought it was a sale there. My actual sell number was 4,200, but it got to 4,100. And momentum's rolling over. So I think the S&P comes lower. And the break of the, let's say, what was the 3,600 level going back to June, and then late September, early October, implies that there could be risk to 28.75. So you take the August high of 43.25 minus the June low. I'm going to estimate it at 3,600. Gives you 725 S&P points. You take the June low, 3,600 minus 725 S&P points. It gets you down to 28.75. That is just out there. But in order for that to be important, again, we're going to have to break 3,600. I would suggest to you that the only time Mike Kantrowitz, I'm certain, would corroborate this, but I don't want to put any words in his mouth. In my estimation, the only time that I saw historically where a triple bottom worked with respect to the indexes, and I could certainly be wrong, was in the 08-09 period. And so if we come back down to 3,600, I would not expect it to hold. Steve Shobin told me long ago that support levels are good when an item moves away from it quickly. Weak support or a weak item will continue to be drawn down to that support level. So my estimation here is that the S&P remains weak because it continues at least 2 times now to be drawn to 3,600. I think coming down the third time, it will not hold. And then, George, you were kind enough to ask about growth to non-growth. I continue to prefer non-growth to growth. Some would call it value. I just call it non-growth because I didn't want to have to define value. And I prefer the 4 components of the non-growth side of that equation. That's basics, energy, industrials, and financials. Now there is a rub here, and I'm going to criticize myself here. So if anybody else wants to, they're certainly welcome. The amber flashing light to this scenario right here is that the bank stocks are weakening. There are 5 gospels. 4 of them occur in the New Testament of the Bible: Matthew, Mark, Luke, and John. The 5th gospel is the stock market cannot go up if banks go down. That's the 5th gospel. You can't fight it.
John, you're gonna have to give these. This is a keeper. I gotta tweet this one out. We'll talk about it offline. All right. So the 5th gospel is the market cannot go up without the financials. Is that right?
No. Financials don't have to go up. They just can't go down. So
the market can't go up with financials going down. Got it. Okay.
Period. And so if you take a look at the KBW Bank Index, I mean, that looks pretty darn weak. That's really in bad shape. I mean, take a look at Bank America. I know JP Morgan had a giant rally from the October low, but I certainly couldn't chase that, especially if Bank America did not corroborate. And Bank America got through its 200-day and then rolled beneath it again. I mean, the stock trades at $32. It looks like it has risk to 20. And so that's the risk. I mean, take a look at a weekly chart for Bank America. You could certainly go back 10 years, but you'll notice that it bottomed relatively at the COVID low at around the $20 area. The breakout level in late 2016 was about 20, high teens. And it's below a downward sloping 40-week moving average. Relative to the S&P, it's poor. And its momentum indicator, it looks kind of, punky to me. So I'm concerned about the banks. That's the rub here. And I will tell you, and maybe others can corroborate or dismiss this, but when you speak to some institutional investors about perhaps some risks in banks, their general reply is, yeah, but this isn't 2008, 2009 all over again. The banks are much healthier. Their balance sheets are much healthier. And of course, there's no way I can dispute that. But I think their complacency is the risk. If you're only concerned about banks is that they can't be GFC type scenarios again, well, then I guess you're never concerned about banks. But the last few times Bank America peaked roughly in 1998 at about $40, the stock got to 20. Before GFC, of course, it got to 55 and then got down all the way to single digits. But okay, let's leave out the GFC period. This time, Bank America peaked at 50. Why? If the top of the range is somewhere between 40 and 50, why can't the bottom of the range be 20? So I'm not saying this is GFC all over again, but I certainly think Bank America has risk to 20. If it has risk to 20, I really think it's going to be very difficult for the S&P to hold in.
You know, it's interesting, John. I was chuckling to myself when you're going on about Bank of America and the financials. Um, I think in recent months, people talk about housing, and it's kind of the same catechism. Oh, well, we underbuilt housing for so many years. We don't have the excess in mortgage financing that we had in the GFC, blah, 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 blah. But then I think back to the great Ivy Zellman. We had her in a space back in June. She's so far ahead of the crowd. It's not even funny. Everything the Captain Obvious on CNBC has been talking about now, it was spoken about in these spaces with Ivy 6 months ago. And she made the point that history rhymes, John, as you know, it doesn't repeat itself. Yes, we don't have the same excess in financing, mortgage financing we had during the GFC. But she pointed out, we also didn't have Uber. We didn't have Airbnb. We didn't have Bill to Rent. We didn't have, Blackstone, and Starwood and all these guys hoovering up large parts of the housing stock. She pointed out that 24% of all the transactions in housing this year were secondary, not primary transactions. Those are all economically motivated. Those are transactions where the person buying the home is not living in it, and what was demand becomes supply. And so again, it kind of bears parallel to what you're talking about with the financials. So John, with all that in mind, for the average guy in the room actually, before I go to that question, one other question for you. As you speak to clients all the time, a lot of big money. Um, what can you observe? You and I have always talked about, I've always asked you the question about what's wrong with Louis saying. The odd lot indicator, of course, he'll be in the federal witness protection program. We're not going to mention names. But when you think about the questions you're asked, and more importantly, the questions you're not asked, and what the smart guys are telling you, and what the idiots are asking you, and you just stand back and look on down from the field, up from the down from the press box. Sort of big picture takeaway. What would you say in terms of where investor attitudes are? And the psychology, I don't think we're in capitulation or despair yet at all. I don't know where we are. Maybe we're just sort of, I don't know if we're in denial or, we're in denial and the market rallies back up again. So it's like, you're saying there's a chance. All right. So how would you describe investor psychology and what's your sort of big picture advice for the average investor in the room, John?
Okay, so I'm not going to give any advice because I don't have any skin in their game, and if something happens, I'd rather be a fool for myself, not a fool for anybody else. But I'll just share what I hear. So, for example, I'm negative on Amazon, um, and I've been negative for some time on Amazon, and my target has been 75 for Amazon, and so I keep hearing that Amazon is cheap at these levels, and so I've said to myself, but not to anybody in particular, I guess it's going to be really cheap when it gets lower. So I think that Amazon is kind of emblematic of what I'm hearing with respect to big cap tech, that they're cheap. But I mean, Amazon is now back to levels seen in kind of mid 2018, and I think it's going lower. It's a huge top relative to the S&P. It folded like a used napkin relative to the S&P. And I think that the case for big cap tech is that some investors that I speak with believe that, this is just kind of a one-off year for them. My take is that this is kind of emblematic of the last time tech peaked and that it was a long time before they came back. So I think investors are going to be pleasantly unsurprised, or not pleasantly, but just surprised on a negative way with respect to how long these stocks can be out of favor. Number one. Number two is, it's my estimation that most professional investors continue to believe that the Fed will, in some measure, come to their rescue. I've thought for a long time, for many months now, that was really kind of the only narrative in place. And also, everything is on a razor's edge with respect to catching a rally. Everybody is really intent on catching a rally, which suggests to me that most rallies are not likely to be the one. Only Walter Diemer is fond of saying, when it comes time to buy them, you won't want to. And I don't think we've gotten to that position yet. So I think sentiment is still kind of a little bit screwed up. I know that everybody will tell us that everybody else is negative, But you can't out-contra yourself when you make that kind of statement. If you think everybody else is negative, well, then you want to buy them, which means that not everybody is negative. So I think that we still have more difficulty to go through. We break 3,600, 2,875 is the next figure. And I think the big risk here is in the banks. Take a look at Bank America, as I suggested. Take a look at Wells Fargo on a monthly basis. I mean, if you took the names off of these charts, there's no way you're buying them. And that's what I think the risk is here, George. I've probably spoken too long, and there are other
No, John, this has been awesome. You're so generous with your time. Just real quickly, just FYI, if you look in the nest, John, I took the liberty of tweeting out and posting there a couple of your charts. You may want to speak to them. The first one shows, I love your reference. For those who are not basketball fans, maybe, John, you have to fill them in on who Hakeem Olajuwon was. Okay, but the first one shows the S&P being rejected at 4,200. And then you've got a long-term chart of the Dow, and then you've got the growth, non-growth. So I don't know. You already kind of touched on this, but if you just want to quickly just those 3 or 4 charts are up on the nest. Just
yes.
FYI.
Okay. Thank you, George. So Hakeem Olajuwon is the all-time leader in block shots in NBA history, and I thought 4,200 kind of loomed just like he did when a shooter got into the paint. And then you were near 4,200, downward sloping 200-day, and the MACD was overbought. So to me, that's a big problem. And then growth to non-growth, I think George just mentioned, which is something that I just referenced. And then I went back on the Dow to 1900, and I know that the Dow was up 6% in November and 14% in October. It had a 2-month gain of almost 20%. It beat by a little bit the 2-month gain from January through February 75, which was part of an early 75, early 76 rally of 75% that took the Dow to the top of its range at 1,000. And if you remember from your chart history, 66 through 82, the Dow was kind of capped at 1,000. And then, after that, it was a big sale. And then there was a 20% 2-month rally in June, July 38. That was part of a bigger move. But then when it failed, it was down another 41% over the next 41 months. So we had a big move in November and December. And when you have big moves in bear markets, you want to be sellers of big moves in bear markets. You don't want to chase big moves in bear markets. If it were a bull market, then certainly we would take a different strategy. But I think you want to be sellers of big moves in bear markets.
Okay, John, on that last point, you've made the point many times in the past. Just to remind everyone, you may want to elaborate on it. I think I've got the numbers right. Really stuck with how counter trend rallies and bear markets are a feature, not a bug. This is nothing. This comes with the territory. No one ever said bear markets are easy. They're treacherous. They're very, very hard.
Very treacherous.
And the other last one too. Maybe just put the current bear market in the context of past bear markets. But I committed to memory your statistics from the 2002 to 2002 bear market, where I believe you said something like 47. In the context of Nasdaq falling 80%, the market was up 47% of those days, and I think there were 15 counter trend rallies of greater than 10%, and 10 counter trend rallies of greater than 15%. So if we look at the scoreboard vis-a-vis this bear market, what is it saying, and how does it stack up relative to that, and what can we glean going forward?
Okay, so I'll tell you the numbers. So far in 2022, I think I've gotten them all. There were 5 rallies. The first one was almost 9% in 7 days. The second one was 11.5% in 15 days. The third one was 10% in 8 days. The fourth one was big. It was almost 20% in 40 days. That went from kind of mid-June to mid-August. And then this last one was 17% in 35 days. So we've had five rallies and so far 5 declines. So I think in the bear market, you're going to get another decline. And if we get under 3,600, it'll be down to 2,875. And George, you were kind enough to mention those NASDAQ figures. I mean, they're not, NASDAQ, there were 15 rallies, I think you said, and they were the average, the average length of time was 17 days and you got 23%. The biggest one was 75 days and you got 51%. So I don't know that these have to repeat in detail. History doesn't repeat, it rhymes, but I think this is not that dissimilar in terms of the overall activity. You come down, you get oversold, you get a rally, people get juiced up about it, and you kind of stop at or near the 200-day moving average. And then when it slopes downward, it's Hakeem Olajuwon.
So, John, with that in mind, are you just going to let the tape do the talking, or given that we got up pretty close to the 200-day in terms of where we are right here, right now. Do you think this counter trend rally is done, or the jury's still out? You did see some more confirmation of a decline before you'd want to say that?
No, I will say I could be wrong, but I will say with some measure of confidence that I think this counter trend rally's over, and it's over because of the way Bank of America and Wells Fargo and the other banks act. I mean, take a look at what MTB did last week. I mean, you don't get an MTB kind of situation in a bull market or in a bull market for banks. I mean, it was bearish
100%.
already. You had a downside gap in October. You created a ledge beneath a cresting 200-day moving average, and then had another downside gap, on Wednesday. That's not bull market action, and I doubt that this is just going to be a one-off for MTB. So I feel pretty confident that the rally is over, and this time it's over because the banks are failing.
Lastly, John, and if you want to stick around for some questions, that's great. This has been unbelievable. But I did put up finally, probably the most important chart. If you look to the next, John, I put up your chart from your most recent deck from the other week, showing what happens to the market once you get the much desired pivot and what that's meant in the past. You just want to elaborate on that a little bit?
Okay, so I wanted to go back to the 70s and try to see what happened to the S&P after the Fed cut rates. And then I juxtapose it with the recession because Bloomberg's, allows you to do that with their great charting package. And, the early to mid 70s, the S&P fell 41% after the Fed cut. And then it fell 17% in the early 80s after. And then in the early 90s, it fell 20%, which was still in a major uptrend. And then, of course, in the tech meltdown, it was down 38%. And if I remember, I think during that time was when Marty Zweig penned a Barron's column, kind of telling where he had gotten a little bit too aggressive too soon with respect to the Fed cuts. But that was down 38%. And then GFC was kind of the granddaddy of them all, down 53%. So I think we as a business are kind of too complacent and too confident in the Fed's ability to get this right. I mean, if the Fed were a shooter in basketball, they're ice cold. You wouldn't pass them the ball at all. I used to say to my son when he was playing point guard, I say, John, why are you passing the ball that part of the game? I said, you don't want to pass the ball to a guy who's a worse shooter than you. You want to pass the ball to a guy who's a better shooter than you. So I think if the Fed were, on your team, the coach would have put him on the bench already because he's cold as ice, or the Fed's cold as ice. So I don't think you want to give any confidence to what.
Yeah, John, they're doing just the opposite. It's like they got J-Pal in the pivot as if he's Shaq, and they keep lobbing it into him, pounding it into the post, even though he keeps bricking it. Like, this makes no sense, John.
Well, I remember, playing hoops when I was younger, and I had a friend of mine who he was like a black hole. The ball went in, it never came out. And I said, Anthony, aren't you going to pass the ball? He said, John, I'm a shooter. You shoot if you're hot, and if you're not, you shoot till you get hot. So maybe that's their MO.
It's hilarious. John, you're on fire. All right, so let's go. We got a few smart cookies.
Thank you for your time, everybody. Thank you, George.
Yeah, John, that's great. Stick around if you can. If not, everyone give John a follow. He's just fabulous technician and wonderful guy, and he's just so generous to come and share his time with us. Hey, Mr. Newman, how are you, my friend? Please unmute yourself. You got some questions or comments for John, Mark?
Hey, yeah. Hi, George. Hi, everybody. Before John gets moving, I did want to ask him a couple things because I just want to comment on some of the things he said. First of all, on the banks, I couldn't agree more. All you have to do is look at Credit Suisse, right, to know something's rotten in Denmark or Switzerland or whatever. John, you had mentioned the Asian currencies against the dollar. I wanted to get your thoughts on EEM, EWZ as they relative to the currency moves. That's number one. Number two, you mentioned about tech, and I really agree with you. And I want to talk a little more about this later, but your time's short. Everyone sort of needs to remember that in between 2000 and 2015, Cisco and Microsoft did four baggers with revenues, 4 times increase over that 15-year period. And Cisco went down 50% in that 15-year span. and Microsoft was flat. And so we could debate sort of how big this tech bubble run up was in this time around, and we know how it was back then. And that was a 15-year period where those tech stocks, well, Cisco did minus 50% and Microsoft did nothing, and their revenues expanded massively. So I do agree with you. It's very crowded, and I wanted to get your take on sort of order of magnitude relative value in the bubble this time in tech versus then, if you could do that. So EEM, EWZ, the banks, and then the tech talk. Yeah.
Okay, so thank you very much for the questions. So I'm going to try to do this fairly quickly. I think I want to believe that EEM on a pullback will hold, and that it can start to show some relative strength vis-a-vis the S&P 500. And I think it could happen if I believe, and I do, that the dollar's not likely to go up big here. However, the rub is that I want to sell Brazil. So that's compromising the EEM situation. I think the IBOV itself and then the EWZ, the ETF, are sales. So that certainly throws a wrench into what I want to believe for the EEM, or what I think could happen, because Brazil, I think, is a sale, both in local and using the ETF of the EWZ. And then, with respect to the banks, and I know you mentioned Credit Suisse, and I know it had a little bounce recently, but I think the KRE is a big sale right here. It's below its downward sloping 40-week moving average. It got the Hakeem Olajuwon treatment twice in the last few months. It is rolling relative to the S&P 500, and I never had any luck with my own money trying to buy items in this position relative to their 40-week moving averages. And I always think of the 40-week moving average and its slope as either the demand line or the supply line. When an item is still joined by an upward sloping 40-week moving average, then in general, demand overwhelms supply. But when an item is below a downward sloping 40-week moving average, then supply of stock overwhelms the demand of stock. And I think that's a simple equation for me to remember. And in addition, and I don't like to pattern guess, because I know you get kind of knocked around for that, but I might be able to craft a scenario where the KRE has built a head and shoulders top. The left shoulder was kind of spring 2021. The head was late 2021, early 2022. And now the right shoulder is being formed in 2022. And it would suggest to me that the downside target, and I'm not taking the full count, I'm only taking the right shoulder count, would be down around 50. So that's a pretty nice trade, I think, here. And I think you have a tight stop here. It's worth doing. And so I'm not a fan of the banks. And again, that's the biggest rub here. And with respect to the magnitude, I think was your last question, comparing this time to maybe what we've seen in the past for, let's say, tech. I think I got that right. I know that the NDX was down 80+% from peak to trough last time. I don't think I'm good enough to estimate that sort of decline. However, if we merely take the NDX, and this is not a forecast, I'm just kind of, going back and forth as I would do on the phone with an investor or in a meeting with an investor. If we just take the NDX back to its last real breakout level, that's at the 8,000 level. So that would be down more than 50% from peak to trough. So certainly would not be the magnitude of what we saw in the last time, but it is not crazy to think that it could get back to its last breakout level from a base which happened in late 2019. That was really when we accelerated this time, which was, to me, akin to what we did in late 98 into the 2000 peak. However, I will tell you that the acceleration this time into its peak, at least based on the growth to non-growth relationship, was greater than any prior acceleration for that relationship as far back as I have data. So we might be able to say that the excesses into the peak this time, especially for growth to non-growth, were worse than at any other time for which I have data.
Thanks for that. Hey, Mark, great question. Hey, John,
Thank
if you got time for one more question before you got to go, she's been waiting patiently. I'd like to have, she's got a couple really good questions for you. Sourire Japon wants to ask you. So, Sourire, please unmute yourself. You got a question for John?
Yes, thank you for bringing me up. First of all, I would like to say that this year has been wonderful for me, thanks to listening to George Noble Spaces. So big thank to you.
You are embarrassing me. Thank you. I had no idea you were going to say that.
But that's totally true. And my two questions. My position has been cash, note, RORO, gold, silver, and all value. And I've been in bullish on gold and silver and value stocks for around value always, but gold and silver for 1.5 years. It never went anywhere. And now everyone that I'm listening to is bullish on gold and silver. Isn't that a contrarian indicator? Because everyone expects it to go higher. And number two is if I'm looking at S&P equal weight chart, it looks like it is still very high up, and the stocks that went down were all growth this year. And I'm afraid that I think that we are going to get very deep recession next year. In this case, don't you think that value stocks are going to catch up because they have been holding pretty well this year, and they might fall even lower than growth next year? Thank you.
Okay, those are really good and challenging questions. I'm going to take the gold and silver one in order first. I'm going to politely disagree with you. I do not believe that everyone consensus, a great majority of people are long gold and silver. I don't believe it for a second. First off, I will tell you, and I'm old now because I have a lot of gray hair to show it. I don't even know that there are 5 people left in the business managing money who ever made real money being long gold. I think the people who did make real money being long gold in prior cycles have either passed from this earth, rest in peace, or have gone on to some nobler pursuits, no pun intended, George, nobler pursuits with respect to their life's work. So I don't think that there are a lot of people who are long gold and silver. It might be that they speak about it, but I don't believe that's the case. Certainly, I would tell you that there are fewer people that I speak with long gold and silver than were long energy coming into 2022. So perhaps that's a good analogy. There were few, if any, institutional investors long energy coming into 2022, and there are fewer people long, in my estimation, gold and silver here. That's number one. Although I happen to agree with you that I think both are going higher, and I think the top of the ranges are in order for both gold and silver. And then with respect to your question about the equal weighted S&P, I think that's a really sharp observation. I do believe, however, that the relative performance will continue to favor value or non-growth relative to growth. I think that growth is in an out cycle relative to value or non-growth. And I want to sell any rally where growth outperforms non-growth. But your question is sharp, on the money with respect to the equal weighted S&P. And if there's going to be a decline, it likely will hit the sectors that have not yet really been hurt. I think it's a really sharp question. Thank you for your questions.
Hey, John, if I could, you triggered me with a couple things you just said. One, when you mentioned gold, just for the audience, because I think I know your view, but one of the narratives, or let me just get to the chase. What do you think on Bitcoin without putting narrative with it? What does the Bitcoin chart look like to you? And then two, coming back on energy, is this just a pause that refreshes on energy, i.e., we're correcting to perhaps some breakout sort of level, and then we're going to go on again on energy? So tactically, yes, I get it. You're negative on energy and energy stocks, but structurally, do you think we ultimately go higher in energy? So one question is energy, the other one is Bitcoin.
Okay, so I'm going to go first on Bitcoin. I've had a long long-standing target from November of 2021 of 10,000 on Bitcoin. I think it gets there. Items that go sideways beneath downward sloping 200-day moving averages, those are not bases. Those are ledges that break again to the downside. And you'll notice, and the listeners, I believe, will notice that Bitcoin's last three declines were kind of very stair-step-like and measured. You went sideways from June through August. You tried to put in a bounce to the 100-day, failed. And then you went sideways from kind of early September through early November, failed. And now we're going sideways again. I think it's, first off, it's remarkable to me that it's not at 10,000, but or lower than where it is here. But I think this is not an opportunity to turn positive or to look at it with some measure of a glint in your eye and say, hey, maybe this is the bottom. I still think it's way too soon. And then number two is, with respect to energy, I'm going to use a Stan Weinstein line. And Stan Weinstein is fond of saying, I try not to look around too many corners. And so I don't think I'm good enough to answer your question.
I love it, John. You call him like you see him, and you're one of the few guys on the street, been around long enough to be able to say and not be ashamed to say, I just don't know. Love you for that. All right, before we go to Neely, because we're going to do some consumer questions here, a lot to talk about with the consumer. I want to get AB, if you got a quick question, AB, and then I want to go to Neely. AB, please unmute yourself.
Thanks, George. Happy Sunday to everybody. Thanks for hosting the space. And the change, quick. Obviously, you're like an auto follow, listening to you with your wisdom and experience and whatnot, and just what you have to say is incredible. And this is a great space. There's so many smart people in here. I just looking at the deal. It's just like the Fed talks the talk. Can they walk the walk? I think the Fed at this point, I guess my 2 cents there, how many tools do they have left in the toolbox? What's the toolbox? They're just going to keep fucking raising the credit card limit. We've got 31 trillion, 32 trillion, 33 trillion. Interest rates going up. How do you service the debt? What goes on? They're all fucking hat and no fucking cattle. The fucking banksters own them. Who's running this fucking clown show?
I don't know if that question to me, I don't think I can answer it one way or another.
Yeah, no, AB, I think we're all kind of disgusted with the Fed, and again, they, if someone wants to get up here and talk about how they're actually talking the talk, because I think probably most people in this room would all say no, they talk is cheap. Show me the money. They don't got, John Roque. I don't know if you saw this, but I put a tweet out the other day. I can't remember where I borrowed it from, but after all the machinations, all the huffing and puffing, I think I can. It was only last week or the week before where on a 12-month rate of change basis, the Fed balance sheet went down. They've been slowly taking money out of the system the last few months, but let's not forget, they were still buying mortgage-backed securities into the face of the biggest bull market in housing history has ever seen. So they only started shrinking the balance sheet, I think it was from late spring. So on a 12-month basis, it's only now for the first time that the balance sheet's gone down. Forget about what's happened with reserve repo and all the other nonsense, okay? It's just these guys, I'm told I should refrain from using 4-letter words, okay? These guys have no cred. None. But yet, people are begging. So many of your clients, John, that you speak to, the ones that are overweight tech and FANG stocks, please, Kathy, please, we want more liquidity. No. These guys are full of it. And I'm not going to use a stronger term, but you know what I'm saying, John. I mean, it's like a giant kabuki theater.
Well, it is. And I think, many investors have been conditioned to just expect that they'll raise the magic wand and make things better again. I just don't think they're going to do it now. I think certainly you and I may have talked about this. I know I've talked about it with others. I think ultimately kind of the Fed is the last public institution standing with respect to not being hammered for, let's say, big mistakes or, public indiscretions. Certainly the presidency, I'm not talking about presidents, but the presidency, Congress, the Senate, Major League Baseball, Boy Scouts of America, you could go on and on. But I think they're the last ones. And I think it's important to read the Lords of Finance, which the subtitle was "The Bankers Who Broke the World," and I think it's important to read "The Lords of Easy Money," which was published, I think, earlier this year. I think both are must reads with respect to seeing how much this is formerly, on the money group is now, they're cold. And when you're cold, it takes a long time to get hot again. I think that's what it is. And I don't expect that they're going to be able to right this ship by doing what they're doing.
This is like the Boston Strangler, Andrew Toney. Like when he's on, you could triple team him.
Oh man, he was hot as heck.
But when he went cold, he put it up from 35. Wouldn't even hit the backboard. It'd be like, what the hell? I mean, Jerome Powell's Andrew Toney on a cold streak.
Yeah, listen, I don't know how many others will get that reference, but I certainly get it.
I have a question, guys.
Yeah, make it a quick one, Raging, because you're speaking out of order.
I'm sorry about that. My apologies. I'm relatively new to space.
Yeah, we have an order in this room, so could you please wait your turn?
Sure. Sorry, when is my turn?
I don't mean to be a jerk. It's just people.
No problem.
People just try to keep an order here.
Yeah, definitely.
No worries. All right, I want to go to Neely now. There's so much talk about the consumer. Neely, you were fabulous on Friday. We were talking about Lululemon blowing up and a whole bunch of others. And you and I were having a back and forth about, tax withholding and everything that's going to happen come the new year. So, Neely, what's top of mind you want to share with the audience? Floor is yours, Neely. Good to see you.
Thanks, George. George, I really appreciate the back and forth, back channel conversations because, you keep us on our toes, both publicly and privately. And I think that is a really good sign of critical thinking. And so I appreciate when you follow up and say, but what about? So just public gratitude for iron sharpening iron, as it were. Hey, I had a question actually for John as well. John, you're like, I'm just trying to eat breakfast. Okay, so here's something that's been interesting. I've been in a handful of spaces over the last 2 weeks with some like total hitters, Chanos, right? Daniel DiMartino, Booth. Just hitters, and have asked you guys consistently this question. And it's been interesting how they're not listening to each other's spaces, but they're basically saying the same thing. And so I'd be curious your perspective on this. I've been asking them, okay, as experts and people who have walked this earth since the earth, cooled and has seen market movements, there are things that because they're factual. There's things that you believe because you've got wisdom and expertise and time that you've invested into that belief. But there are always something that you do not yet know that kind of haunts your curiosity. Like if you had 10 more hours, what would you work on? If you had 20 more hours, what would you work on? And posing that question, and I would love your perspective, but in posing that question, the things I've heard back have been some form of private debt has gone to places it actually didn't belong. That was a near quote from Daniel DiMartino Booth, but, Chanos basically said something very similarly. It feels like it's somewhere in that commercial real estate, somewhere in that lending, totally dovetailing with your banking comment. Would love your perspective and reaction to that frame up.
Well, Neely, John, you want to take that? You there, John?
No, I Neely, I'm not trying to be rude. I don't think I can offer the insight that some of those others suggested. So I'm going to politely say I'd rather listen to some of the other replies. So thank you for the question.
Neely, let me take a shot at that. As Andrew Smithers, I believe, said, well, I know he said it, whether he was the first one to say it, I don't know. Andrew Smithers is a great strategist out of the UK. I first met back in the 80s. He was a senior executive at S.G. Warburg, subsequently merged into UBS, and he actually opened the Tokyo office for S.G. Warburg. One of the smartest guys you'll ever meet. He's in that sort of rarefied Jeremy Grantham type of league, real intellect. He had a great line. The role of a bear market is to return capital to its rightful owner. Again, the role of a bear market is to return capital to its rightful owner. There is no question that money's gone to places it didn't belong. It's like water seeking its own level. It will flow until it finds its level. Too much money was put in the system. We overcooked the goose. And so it got diverted from outside traditional channels into untraditional channels. One of the great things about America is the entrepreneurial spirit, and can always find new ways to destroy capital. And there's no question it's gone to places it shouldn't have. And as the tide goes out on this tsunami of liquidity, and the cost of capital starts to rise to a more appropriate level, there's going to be a lot of wealth destruction. There's no question about that. And rather than deploring that and abhorring that, John, apologies to Muhammad Ali, deploring and abhorring, we should welcome that. And the reason I say that is when you don't have price signals, when prices cease to have information content, you get misallocation of capital. So Mikey in those commercials, when he puts his finger in the wall socket, he gets electric shock. He'll know not to do that again. Well, we need price to once again do what it's done historically, which is, ration capital. There needs to be a signal coming from price. And when there is no signal coming from price, you get the malinvestment excess we've seen for so many years. You get Cathie Wood. You get crypto. You get SPACs. You get NFTs. You get stocks in 30 times sales. I can go on and on and on. What the market's going to do is anybody's guess. I firmly believe it's going a lot lower. I believe John does as well. We've been consistently saying that in these rooms for a year. It doesn't go down every day and every week, but we've gotten it right. And I think that process is incomplete. John, John, this is pattern recognition time now. When you have the implosion of a bubble, let's take ARK, use that as a poster child for speculative excess. And, ARK, I think, peaked at 160, 170. It's like 34th there or something like that. It's 80% from the peak. And I don't have the numbers updated for the last couple of weeks. I suspect she's had some redemptions. But as of a month ago, despite being down 70% year to date, she started the year at 100 and, we're 35, whatever, 65%. She had taken $1 billion net this year. I filed it under the heading of things you don't see at a bottom. So, John, not to get lost too much in the anecdote of ARK, but just using that as a proxy for what we're talking about and the cycle of psychology and the speculative tide coming in and going out. What do you make of that $1 billion coming into ARK, despite the fact that it's down 70% this year? John?
I think that ARK is emblematic of this era with respect to. Please, I'm not equating them, so please, no nasty direct messages. I think that ARK is emblematic of a recidivist criminal who continues to rob the CVS or the Walgreens or the local, supermarket or gas station, and then continues to be let out, and they continue to perpetuate with their crime spree. There are some people who will get to the front page of the New York Post or just inside the New York Post, and they've been arrested 30 times and 40 times, and any rational person who lives in this area or any area would say, how come this criminal is not in jail? And they keep getting another chance. I think it's kind of the same thing. There's a story, there's a dream with respect to ARK and ARK-related stocks. And you don't get a bubble popped until it's down 80 to 90% from this peak. And in my chart packet on Friday, I had a chart for Carvana, and the title was The Anatomy of a Bubble Popped. Carvana has had 8 declines since its peak in late 2021 of about 50%. The last one was 45%, so I'm going to just call it 50. I'm going to round it off. 8 declines of 50%. Its total decline is 99%. As of last Wednesday, there were still 8 buys on the stock. As of Friday, there were 4 buys on the stock. So I guess it's going to take a 0 for the last few buys to give in and capitulate. Perhaps it's the same way for the example that you referenced, George. But the anatomy of a bubble is that items go down 80 to 90%. Some of them go all the way down. That's what happens when a bubble pops. If it's not down 80 to 90%, it's not popped yet.
And by the way, John, maybe you always have a funnier, more articulate way of expressing it, but John, what's the line about, an 80% stock that cuts in half is 90%? You know what I'm talking about? It's like there's just so many pieces of crap out there that are down 80 that should be down, or down 70 should be down 90. I mean, down 70 and down 90 is still another 67% decline. So when you look at a lot of these pieces of merchandise, as you would affectionately refer to them, they're floating around under the 200-day that are down 70, and people say, "Oh my God!" I mean, everyone's anchored off of the price from March of 2021 when speculation peaked. But when you go back and look in the overall scheme of things, I mean, I just go through these things. I can find, you pick on Carvana, maybe it's one of the shiniest of objects, but all the ARC-like merchandise, and Neely, we are going to come back to you in a second here. All the ARC-like merchandise don't get anchored on the fact we're down 70. To me, a lot of that crap looks like it's got a lot further to fall. What would you say, John?
Well, let's use ARC as the example, and this is not pejorative to one person, but ARC's down about 80% from its peak, and it's burdened by downward sloping moving averages, and it looks like it's a shelf that's ready to break. The breakout level to the upside for ARC occurred actually in late 2016, early 2017, which was in the low 20s, which would put this down almost around 85 to 90% from its peak. That to me is not so extraordinary here. And if you're of a certain age, you might remember there used to be a television show called That Girl, which starred a woman named Marlo Thomas, who was the daughter of Danny Thomas. Her hairstyle is the emblematic example of what these items look like that break out, go to excessive peaks, make this rounded top, and come back down to the bottom of that breakout level again. They're like distribution curves. The distribution curve for ARC is not yet complete. And Carvana, that's an example. That's the anatomy. And find other bubbles. They're going to look like Carvana before it's done.
John, and Mark Newman, you got to come, but just hold it for a second here. John, I want you to come to a bigger point. This is the old, give a man a fish, you give him a meal, teach a man a fish, you give him a livelihood. In my experience, John, you may disagree, but I suspect not. Could you explain? And if you don't want to go there, that's fine. I'm not put words in your mouth, but I think we go to the same church on this one. How sometimes, again, rather than getting anchored on price, a stock which is down 70% could be, might be, and probably is under certain circumstances, a better short down 70 than a stock which hasn't gone down at all. It speaks to chart structure, formation, price momentum, etc. And so, the role that momentum plays in price structure. And so, I know you take the fundamentals and you put them to the side for a second. And we always like to joke about how, what is it, John? Fundamental things happen for a technical reason, or is it the other way around, right? But the idea that some people get caught on, I can't short XYZ. All right, let's take the electric car company that shall not be named, all right? How can I short this thing? It's at 180 down from whatever, 350. It's been cut in half. I would argue very strenuously, one, from a chart formation perspective, two, from a liquidity perspective, macro perspective, three, from a company fundamental perspective, the electric car company that shall not be named is a better short now than it was at twice the price. But leaving fundamentals aside, John, could you just speak to technicals and price structure and how people shouldn't get anchored on price, and how something like the electric car company now, and it pissed me off, but when that thing was going up a year or two ago, you were saying, hey, this can go higher. So can you explain to me that, absolute price levels don't tell the whole story, and how a stock which is down a lot can actually be a great short?
I actually am going to try to take it in a different way. The stock that's down a lot is actually reflecting that the fundamentals are bad and likely getting worse. The chart reflects the fundamental story. And maybe it was first to go. Maybe the chart was first to turn, but the fundamental story kind of catches up to it. So I would agree with you that the better short is the stock that's already down a lot, because it is telling you that the fundamental story is bad and likely to get worse. You know the way the business works. Nobody wants a short 52-week lows, but there are 52-week lows because the fundamentals are bad, not just because the technicals are bad.
John, I think it's such an important point that so many investors need to learn and understand more. There are certain ponytailed former NFL football players. Actually, I think one only made the University of Minnesota. I'm not sure if the other one played pro. I don't think he did. Nicoski probably can tell me. Any event, and they coined, or at least used, one of the most expensive sayings, idiotic stockbroker terms out there I've ever heard in my life. Price is truth. Nothing could be further from the truth. Price is not truth. Price is a truth at a point in time, but price is not the truth. Was price truth when Facebook was $350 8 months ago? Was price truth when Qualcomm was $750 on the last day of 1999? I think not. And so people get, again, to take the line from, he knows the price of everything and the value of nothing. I mean, John, maybe go a little bit more on how, when one uses price, I guess maybe when momentum is positive and you don't want to sell new high, and the idea that sort of in Nicoski, you should get up here. It appeals to one's ego. Everyone wants to be, no one wants to sell anything in a hole. They only want to try to sell things at the highs. But the problem is when something's going up, you never know how high it's going to go up. And when something's going down, you never know how low it's going to go. And as you point out, the fact that it's going up might be telling you that things are getting better, that it's going down, that it's getting worse. So it's nothing but valuation. But John, could you just speak to, in your experience, how people misuse price? And I actually think it's one of the big problems in this new era. They talk about, democratization of finance. Everyone becomes an expert. Everyone can become a technician. Just get out your crayons and a ruler and draw some Fibonacci lines and, blah, 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 and you're good to go. It must make your hair catch on fire or your head want to explode, or whatever metaphor you want to use, when you see the sort of, what I would call, I guess, for lack of a better term, amateur technical analysis that goes on at home, how people so misuse it. So I don't know what part of that you want to address triggers you, doesn't trigger you, or maybe just say, George, I don't know what you're talking about. But I just think we're getting into an era here which is just so problematic for so many individual investors at home. Have at it, John.
Okay, I'm gonna try to answer you in a short fashion. I'm going to turn it over to David Nicoski. I'd like to hear him speak. He's probably heard me enough today. I think that in a business where all of us make a lot of mistakes, and understanding that we're not going to get them all right, and we could get something wrong and then it turns out to be right, it's just the way the business works. If we looked at every one of our charts with either a 40-week moving average or a 200-day moving average and figured out where is the item in relation to that moving average and what is the slope of that moving average, I think I'm talking about me now, my mistakes would be fewer. When we go against that little dictum, then I think we make more mistakes. When you try to buy something because you think it's bottomed, but it's below a downward sloping 200-day, you might get it right. But the odds are that you're not going to. And I think it was Jesse Livermore who said, I'm going to attribute this to him, the only people who sell tops and buy bottoms are liars, because it's that difficult to do. But if you use the slope of the moving average and where the item is in relation to that moving average, I'll make fewer mistakes. And, Meta, Facebook, has been a problem since earliest in the year, when it got below its 40-week moving average and it crested, which was before the first big down leg. But even if you didn't sell the first big down leg, you certainly could have sold it there at around 225. You'd still be okay, I think. So I'm going to leave it to David. Thanks for your time. I spoke too much. George, always a pleasure.
Thanks, John. Hey, Newman, you wanted to jump in?
Yeah, hey, I just wanted to touch on something, and this is, George, you said it before, and I think it's really, really critical. The misallocation of capital is what has gotten us to this spot where everything is distorted, right? And I'm going to not talk my book here just as much as pointing it out to people the way I'm seeing it. And the
record level low interest rates that we had over the past decade has created this bubble. George, you mentioned the NFTs, the SPACs, all that stuff. I do think that ESG has been a major contributor to misallocation of capital. And now we had Sam Bankman-Fried marry crypto and ESG because he used a lot of ESG, had high ESG ratings on FTX. And the bubble has been burst now. John pointed it out with Carvana. He's right. Tech is still very overcrowded. I think that the distortion that's being created, and you can see now BlackRock's on the hot seat, Larry Fink, Vanguard is too. I think this unwind, like you all said, George and John agree, like the trajectory and the pathway is lower. And I think the bubble has burst. And George, you said it with ARK. Nobody realizes it yet because they're still piling in. I think we are at the beginning of a massive bubble unwind here. And I think that going forward, it's going to be extremely hard to navigate for most people, 23, 24 going forward. I think that the ESG unwind, because rates are higher and not really going down extensively from here, that misallocation of capital, those errors that were made at the corporate and investing level are just going to be magnified going forward. I think everyone really has to know what they own in 23 and 24 going forward. I just wanted to share that because I think the risks are very lopsided going forward. Very.
Thanks, Mark. All right, so Neely, you triggered us, and we kind of like went off the deep end and answered a question. You put the cat amongst the pigeons. But I want to come back to you, Neely. I know we've got Philip up here and Baron, who we're going to get to in a minute. But Neely, I wanted you to weigh in a little bit more. You asked a question about money going to the wrong places, and we went off the deep end in our answers to you. But let's come back to the consumer, Neely. In how's it looking to you? You pointed out a couple months ago that, things started to get better, largely at about the time gasoline prices started to go down. Oil prices continue to plumb new lows. But you also pointed out in the space the other day how, given the calendar, we had 5 weekends instead of 4. Retailers may panic, blah blah blah. So, how's the consumer looking? And then I see stuff. I mean, airlines have good numbers; they're doing all right, but the cruise ships blow up and blah blah blah. So maybe it's by category, and there are a lot of disparate trends. But I mean, I don't know. To the extent, just give us a rant, a sort of a free association on the consumer, Neely. So I yield to you, Neely. Please, the floor is yours.
I will share some perspectives with you all. And thank you, George. Just a little bit, George knows this about me with a little bit better background. Used to head the consumer research practice over on the sell side over at Piper Jaffray, which is now Piper Sandler. Left there 6 years ago. I now advise directly CEOs and boards about matters of the consumer economy, all through an economic lens. We're often in boardrooms talking about 3 and 5 year type trends, but obviously cognizant of the near term as well. So it's a very bespoke research practice is what we do. So here's a couple things to keep in mind. All consumer purchases begin with an economic reality. Like every single purchase begins and considers an economic reality. You can only spend what you have in your pocket or what you see that you believe you will have in the future. Okay, a la credit. Like that is a fact about consumer behavior. And so we can have the conversations about like all the different disparate sort of categories that we see out there. But the simple truth is all consumer purchases begin with an economic reality. The question is the economic reality the same for all consumers? The answer is no, right? We actually have a tale of many different consumers right now, which has made 2022 and looking into 2023 a little bit more difficult. Candidly, the job was extraordinarily easy in 2020. Like that was an easy year for this girl, right? It's like, okay, well, $2 trillion of direct stimulus payments, everyone's at home and only people can buy goods online. I got this on lock, right? Like that was easy. This has been far more difficult. And I think the thing that I keep coming back to, and I think in some way John keeps referring to this, and Newman, I think you've also made references to this in some past spaces, if I'm recalling correctly. Small business, I think, is what's getting overlooked. When John, you were making that comment around is the Fed even talking to a civilian? They really don't understand small business from my vantage point. And we do advise CEOs from time to time as they go and have conversations, with their federal, with their district Fed Reserve banks and what have you. So we do have a sense of what the questions are being asked and how they advise and are advised. But the concern I have is you have about 32 million small businesses in the United States of America. They employ somewhere around 60 million people. Those 60 million people are consumers. Out of about 300 million consumers in the United States of America, 150 million consuming households is generally the way you look at it. It's not insignificant. And the NFIB numbers, the National Federation of Independent Business, they're out with their data every single month. It's been completely uninspiring all year, and it has not really improved. And the concern we have is that small business owners have run out of their funding. PPP 1 back in the payroll protection plan, which was a must plan. It basically, it's funny, people are like, it bailed out small business. And I'm like, actually, I think it bailed out the government because they didn't have the means to basically say, oh yeah, you can just fire 24 million people overnight. We're going to go ahead and give them all their unemployment benefits overnight. Like that, it was a way for kind of win-win-ish, for both small business and for government, because the government did not actually have the ability to push through physically that number of claims. And they're like, you hang on to your people, we'll cover you, right? Because it would have been more than 24 million people let go. It would have been like 60 million people probably let go or something to that effect, or even more, because of shutting down the economy. So that was PPP 1, a forgivable loan, essentially. You just had to keep your people in your payroll. PPP 2, same gig. Pretty much if you got one, you pretty much got two. Then you had the EIDL loans, the emergency disaster loans, which just went into repayment for most beginning this last October. Interestingly, we're seeing, at least in our local level, more and more businesses putting out notifications saying that, they're closing up shop by the end of December. We think that that's a confluence of events, including, rent forbearance. They were probably not paying their rent when they should have been paying the rent for some of these lesser run small businesses. And now back rent, it's not just current rent, it's back rent plus current rent, is catching up on them, in addition to the fact that demand is slowing. And so we're swimming a lot, George, actually in the small business data, because we think that's actually going to be the weak link to the economy that no one is really talking to or looking to. And we can absolutely have a conversation around like holiday and, I keep teasing out to you a little bit of our perspective for what 2023, the roller coaster of what consumerism and capacity to consume will be in the spring of 2023. But, it's really what's on my heart is small business.
So, Neely, what do you tell your clients? I mean, it's so hard right now. Never easy, but you go back over since the pandemic, how this has played out. There was a huge shift in consumption patterns from services to goods. Demand was pulled forward on top of it because all the stimulus checks. The supply chain became encumbered. Inventories got drawn down. So orders increased. More and more income got built up. Asset prices went up. Stocks, bonds, etc. Then we had the so-called bullwhip effect, which you and I have been talking about now for 9 months. Companies were ordering not just to satisfy elevated levels of demand, but also the need to replenish inventories. And then inevitably demand starts to slow. But it takes a while for supply chains to respond, to ease, for all those shipments that were sitting on container ships floating around the Pacific or outside the port of Long Beach. Then the supply arrives. So now, okay, you and I spoke about Lululemon on Friday. Inventory up 85%, but the levels of excess inventory they're everywhere, from one retailer to the other, 30, 40, 50%. and it's pretty clear we're mean reverting now. Yes, there's still excess stock of financial assets overall, but those at the lowest end of the socioeconomic strata are already down to where they were pre-pandemic. The savings rates plunged to, I think, multi-year lows. People still have excess savings. However, their balance sheets are now starting to get worse as stock prices fall, housing prices fall. But again, on the other hand, debt service obligation levels are very high, or the people's ability to service their debt obligations are extremely healthy positions. So there are a lot of opposing forces here. As I like to, play on words with Alan Greenspan, if you're not confused, you're not paying attention. So what do you say to your clients with all that? I mean, you're on the one hand, on the other hand, what do you do if you're a consumer-facing company, consumer goods or retailer? What do you tell your clients, Neely?
The advantage I have is they typically, cater to a particular income demographic, right? So I can cater my comments precisely and tailor them because all of our analysis is done by income demographics. And so it's like, that, which makes these spaces a little more difficult because I'm like, well, who do you want to talk about, right? Because it's not all the same. But I would say, there is I'll frame it up at a very high level this way, and this is just trying to cut through some of the nuance. If you are in the very low end of the economy, kind of in that under 30,000, annual household income, you're generally cared for through government transfer payments, both at the state and at the federal level. I absolutely care about the welfare of this demographic, to be very, very clear. But whether you're looking at the wage labor end, they are benefiting, or the programs afforded to them, they are benefiting. That is not the group, not the quote, the dollar discount crew, right, that we're worried about. Nor are we really worried about the upper, the true upper income. Kind of think of, the 200 plus K annual household income and higher. These are the market aware group of people. Typically, they are fine with market fluctuations. It's when job loss starts to creep up tremendously and fast. Kind of the velocity of job loss starts to creep up in their areas. And I know there's been some tech layoffs, but generally speaking, they'll get rehired probably outside of tech industry and into other industry and absorbed. There's a ton of healthcare companies that could use a lot of software engineers right now, right? But they're fine, right? They're fine unless we see some sort of massive job. It's the middling group that we are most concerned about, kind of thinking that 50K to 100K sort of demographic, which, in the context of consumerism, it's not an insignificant group of people. I mean, if you look at kind of adjusted gross income of 50K to 100K, you have probably, I'll give you actually a pretty precise number. Just give me 1 second. 16 plus, it's probably 25 to 30 million filers by the IRS standards. That's not insignificant, of a group of people. And that's the group that we're most concerned about as we navigate ahead to 2023 for one particular reason, and that is it's the student loan repayment. The thing that has been overlooked time and time again this year is people have just thought that this is going to go away. And it's been a political move. I have no problem saying that. It doesn't matter who's in power. Things like this, programs are used politically all the time. It was a political move. It was a midterm play. Even within the Democrat Party, Pelosi herself has indicated she knew that the constitutionality of that executive order, or rather the act under the HEROES Act, was very likely not constitutional. It's gone for a constitutional challenge. The Supreme Court is going to listen to this case in February, and the judgment will be delivered sometime between February or when they deliver all their typical judgments in June and July. And somewhere in that time frame, we're very likely going to hear that act is going to lack constitutional basis, it will be, quote, immediately nullified if that is found that way. And if that's the case, then payment processors are going to send out letters pronto. And then all of a sudden we've got to start repaying $1.7 trillion of debt. Why do I care about this? I care about this because I'm, when you talk about being triggered, I'm kind of triggered. I'm actually a pretty calm, cool, Midwest Christian girl, right? But I get triggered when people start putting out charts and they're like, see, delinquencies are at all-time low. And I'm like, well, it's because we don't actually have $1.7 trillion of debt currently being factored into those lovely charts that you're putting out there, right? Like it's a false narrative if you don't consider what the ramifications of what it is to reintroduce $1.7 trillion of debt back onto the balance sheets of obligations. Right now, you can go get a loan if you have student loan debt. I don't have student loan. I just know this because I've studied this. You can go out and get a loan. It won't even show up in your credit report. It's like it doesn't exist. So how many people have been lent to since March of 2020, since student loan debt has been in forbearance, that the calculation would be different, right? Had that actually been in there. And this is the prudence that, this is the prudence of Adam Smith, okay, that we need in terms of really understanding what it is that we're studying. There's a quote, a Smith quote, it's something to the effect of like, a prudent man always studies seriously and earnestly to understand whatever he professes to understand, and not merely to persuade other people that he understands it. And it's that earnest understanding, that what I think we call intellectual curiosity or even moral bravery, that I think is lacking right now, even by some of the people who I consider friends and peers. We really need to understand what's truly on the balance sheets of the consumer, and that 1.7 trillion is coming back. So at least that's our view. So that's the downside to 2023. As you know, I think there are some potential bright spots that could mitigate that as we navigate forward, but it will get very nuanced by income demographic. George?
Neely, that's absolutely superb. I know you're going to trigger a lot of people with your remarks, so please just stay up there. Oh God, shit! Someone, hey, Roque, can you call security? We got the Minnesota crowd in here now. They pulled this stunt, they pulled this stunt on Friday. Now they're back again. So we got Neely and we got Nicoski, and I'm reliably informed they actually know each other. They work together. So these Minnesota folks, they come across as being wholesome and nice and everything, but they have this ulterior motive. But anyway, Dave, always good to see you, and I love that you're back. And you and Roque, two of my faves. So, like John said, he talked too much. So I think, Dave, you're largely agreeing with John, but maybe I don't know how he triggered you, what you agree with, disagree with. But Dave, we yield to you. Go for it, man. Good to see you.
Thank you. And for us Minnesotans, if you think you hate us now, wait till you get to know us. John, it's a pleasure to be in the room with you. Great. John does great work. Anyone that's not following him should follow him. I've seen John's work throughout the years of being on the sell side. I agree with John wholeheartedly, and I've thrown up quite a few charts of the regional banking index, KRE, and it's not something I say looks good. Most people know that I was a proponent of Brazil earlier in the year. After the election, I said it's not something I want to mess with. It's got a huge diamond formation. I've never seen more diamonds in a market. A lot of technicians won't mark them up, but I've marked them up throughout the years. I've never seen more than I've seen currently in individual stocks and individual indexes. One of the things that, I also see, and I came into the room late, so it may have been talked about, a lot of the small caps, micro caps are not confirming, the latest rally. And, it was the large caps that moved up on the US dollar pulling back. And I do think the dollar has peaked, and I agree with everything wholeheartedly with what John said. So it's great to see, some confirmation of, by someone that I admire and respect significantly. It's great coming into these rooms, and that George, I can't tell you how much, you get up here and get everyone together and plan out, from what they're seeing. I've been in a number of rooms where I get experts on an individual industry that I'm talking about, and they come up and they just, they support most of the conclusions you've come to, from a technical basis. So I love that, and it just makes me feel that much more confident when I see what industry leadership is saying. So great room, love it. Neely, hi from northern Minnesota right now, and I hope you're doing well. That's it. Let me know if anyone has a question as well.
Oh, Dave, you up the road? We can do Minnesota talk, George, if you want.
This is like we need to start talking
Okay.
Fargo.
So Neely, Neely and Nicoski, gotta ask you guys something. If I get the Wisconsin crowd, is there like a thing? Can you please explain for those of us who don't live in your neck of the woods, what is the deal between Wisconsin and Minnesota people? You guys like enemies or allies?
We go over to Wisconsin for the cheese, the beer, and the I think that's all it is. And then they come here. They come to Minnesota for their health care. I think that's kind of it. They have the lower property taxes. We have the services.
And Neely, what would Wisconsin people say about if we got Jeff Garbaza in here or any of the Wisconsin people or Chanos? What would they say about the Minnesota people? Like the Minnesota people kind of look down their noses at the Wisconsin people?
I don't know. I inherited it over here, and for what it's worth, I married a Lions fan, so I don't even fit into the football culture over here. I just know that I have the most loyal and faithful husband, because if you can be loyal to the Lions, you can be loyal to me.
All right, so Nicoski, let's go with some of the things John was talking about. John wanted to beg off on energy. He didn't have a strong, longer. I mean, he's been negative short run as you have, but to give him credit, I think he's been even more negative than you have on energy. So we're going to score that one, Roque. I'm not trying to pit you guys against each other. I'm just trying to figure out where the points of agreement are, like concentric circles, Venn diagram, what like two smart guys agree on, what we disagree on. So, but I want to go to the energy call because I'm really intrigued. I'm looking to buy energy again. And John's like, he doesn't want to look around too many corners. Do you have one of those extended telescopes that goes around corners, John? Like, are you willing to say yes, but longer term, you still like the long-term setup? So, like, maybe just flush out energy a little bit more, Dave.
Yeah, I mean, I still believe we're in a secular bull market in energy. Knowing what the economy is going to do is one thing. I pull out some old research, back from from 94 to 2000 to 2008 and 2009. And I've addressed this on a call the other day that got plenty of laughs. The Fed suffers from Munchausen syndrome, right? They get the patient near death and then revive it, and everyone thinks, wow, they saved the market. They always seem to pull a rabbit out of the hat somewhere. And in the confines of energy, I was bullish January of 21 on calling a secular bull market based upon long-term relative strength trends that we were seeing. I got more bearish in a call with you probably right around 118 or so, and saying if we pull back to the 200-day, that's certainly possible. I got a little heated up on Energia and saying this is the time to look at it. And I'm looking at the relative strength trends coming back to 2019. Trying to call I'm happy to lose a 5% upside, before saying I'm actually bullish, but we should be finding some support in here. If China is opening up, and again, you're seeing, as I've mentioned on a number of calls, the BDRY index, you're starting to see some of the metals, whether it's, Chinese iron ore is absolutely vertical. You're seeing nickel bottoming, so I'm going to say I absolutely, and I said it, probably 5-6 weeks ago that, China was bottoming. I know no one wants to go there, and got in rooms with, 700 people and said, raise your hand if you would buy the emerging markets. And all I kept hearing was, sovereign debt crisis, and the real sovereign debt crisis happened in the UK.
But Dave, on the China thing, I'll try to clean this up a little bit.
No, that's okay.
No. I have cruder analogies I use. I'm going to try to clean this up for it's going to be PG rated. You know, let me put it this way: there are certain countries I just won't invest in. And it's not because I've gotten burned. I mean, look, we all like to gravitate towards areas where we've had success, and because it gives us a false sense of confidence in what we're doing. But like just as a general rule, I don't invest in Russian stocks. Period. Why? I don't trust the accounting. I don't invest in Chinese stocks. Why? I don't trust the accounting. I will invest in Brazilian stocks, as screwed up as the macro is, just because they have a rule of law and you can trust the institutions. You can't say the same thing about China or Russia. All right. So to maybe draw the analogy to like a restaurant, for lack of a better one, there's certain restaurants that, maybe have a history of a lot of health code violations and people getting food poisoning. And yeah, if you're lucky, you go in this time, maybe, they got a new chef and they cleaned up the kitchen with Lysol before they cook the food and you won't get sick. But, enough people have gotten sick in that restaurant over time. It's just not a good place to go. And yeah, you can go to your favorite restaurant and maybe get a crappy meal, but, it's a better risk-adjusted return just to go into the restaurant where they don't routinely suffer health code violations. And so I just have an antipathy towards investing in places where there's no rule of law, you can't trust the institutions, the culture is to scam the foreigners, and I'm talking Russian equities generally and Chinese equities. There was a great chart, Dave, the other day. I'll retweet it. I'm sure you've seen it. And you may say it's the opportunity, and yeah, tactically you may be right. And then I don't want to get to an argument here. This is just I'm trying to build it's more constructive to have a sort of it's multiple time frames and have a Venn diagram, concentric circles where it could be short term we agree, long term we disagree. Like if you say, hey, you know what, buy China, whatever, it looks good, yada yada yada. I'd say, okay, that's a rental, and that's not for me. And then I would turn around and show you the 30-year chart of Chinese equities and prove to you that over 30 years, Chinese stocks have been a loser's game. A loser's game. And yeah, they could go up another 50% over the next 6 months. I'm not going to argue about that. But it's just like I don't want to go into the restaurant where too many people have gotten food poisoning over the years. I don't know. How would you respond to that, Dave?
Those are great points, and you would certainly be in the majority up until 6 weeks ago. I as a chartist, I get to remove those emotions. I get to remove the aspect. I get paid to point out things that are inflecting bullishly, and that is whether you like it or not, that's what I do. And
no, yeah, David, I didn't take it as an attack. Please don't take it offensively. I'm just saying,
you know what? It is what it is.
No, but I'm saying a different way. I'm trying to. Let's put it this way. Just if you get fun, respectfully with love, my brother. If I go to a fundamentalist and ask him to make up a technical story, it's not what he's good at, right?
Yeah.
I don't go to a technician to make the fundamental story. It's what I want to do. I want to integrate everything. So you might say, well, you know what? ARC is inflecting. I'm just making something up, okay? Pets.com is inflecting. Carvana is inflecting positively. It went from.
You won't ever hear that from my mouth. Okay?
No, but what I'm saying is, so let's take an absurd example and make it real, okay? So let's take, and I pick any piece of crap you want. Take Carvana or ARC or whatever. Okay, take Carvana. All right. Enron didn't go to zero in a straight line.
Yeah.
All right. Okay. So at any point in time, there are probably many, I don't know how many multiple rally failed attempts there were in Enron where it started to inflect up. All right. So the Nigerian brothers, and I said them by name, where price is truth. Oh, it's going up. It's going up. And if you bought the 1 month call option, the 1 week call options, you would have made 392% in the last 4 days annualized. Please subscribe to our Discord service for $99 a month. You know what I'm talking about, right?
Oh, absolutely.
So how do you and that's what a lot of FinTwit is about, okay?
Yeah.
And you get bozos who know the price of everything and the value of nothing, all right? And see, I told you to buy Carvana. You're a Carvana hater. You didn't buy it, okay? So how do you differentiate, again, multiple time frames? It's to know what you own. So on the one hand, you know what. Hold on, let me finish here. Know what you own, but you got to look at the chart. But look at the chart, but know what you own. So how do you integrate those two, Dave?
Well, you can certainly see in a chart, and when you see it across a whole spectrum of equities or a market, the chances that China as a entire market going to zero is a lot less than looking at an individual stock like Enron or Credit Suisse, right? I don't think China's going away. You might not like the fundamentals. You may not buy it. And I'm not telling you that, gee, if you don't like China and it's going up, we see, like, why would you buy, Luna or FTX, right? Unfortunately, those things make a bottom and go up, and you can say all you want in terms of bad things, but sometimes the market is the market, and you can fight it all you want, and you can stay out of China. That's fine. There's a lot in the U.S. market that is great. But me looking internationally, and I cover 43 markets by geographic region, by sector, by industry. I have probably 10,000 stocks in my international product. I have to just be open minded about what's going on in the world.
And,
When I hear that
and Dave,
people,
I
yeah,
interrupt. Commercial
yeah,
message.
yeah.
And that's why, Dave, I'm really glad you're back in the space. I urge everyone to follow Dave and reach out to him, get a trial from him. Fabulous service. I have no commercial relationship with Dave. What I like about Dave is he looks at the weight of the evidence. I don't know anybody who follows as many markets as he does. And it's, the objective truth sometimes can trigger oneself, especially when you have to turn the chart upside down to make it support your own belief system. So I urge everyone to reach out to Dave and take a trial of the service. I think you'll really find it worthwhile. Sorry, Dave, I just had to plug you. Go ahead.
Thank you, George. So I have to look around the globe, and this is the problem I've seen throughout my 35 years doing technical analysis. Is you get into a hot area of the market, growth outperforms value over 7 years, and everyone wants to play the growth stocks on the way down. There's a lot of value stocks out there. The unweighted RCD, uh, unweighted consumer discretionary is far outperforming XRT, which is predominantly weighted by names like Amazon, which is right near its 52-week low and 2.5, 3-year low. Looking in the field to find out which wheat is growing, right? So you can separate the wheat from the chaff. Is there's a lot of names out there in the US that are working, and we work diligently every week going through 3,000 charts, marking them up in terms of sector and what their pattern is, based on technicals: bottom fishing, positive developing, positive trending. And with that, you can at least go out and see that the indexes are not telling the truth what's underlying the market. And I'm not going to lie to you and say the Russell 2000 looks great, because it looks bad. It didn't confirm this last rally up. I would say I'm structured more towards, we're not getting confirmation by micro caps and small caps, which have a tendency to lead a rally, not to not rally. So I want to see that confirmation within those. But again, there are Burlington Resources, Ross Stores, TJ Maxx. I went into retailers last night to go Christmas shopping. I can't believe that retailers actually don't have sales. I walked into Dick's, there was nothing on sale. I mean, and if it was something you certainly don't need. You
Dave,
walk
yeah,
into,
so Dave, right here,
yeah,
right now, we don't have to get individual picks per se, but
yeah,
you know how it is. Usually in a given year, there are a few key decisions, sector, maybe a couple stocks here, there, whatever. But there are a few decisions along the course of the year in the context of hundreds that you make, which make or break your year. So as you sit here, right now, if you had to write, a year ahead a piece or whatever, um, for those in the room, trying to figure out what to do with their finances, what would you say? I mean, long. I mean, maybe you don't have a strong view on the market. Maybe it's like, what, I want to be in certain parts of the market. Are there? So what are your? I guess what do you say your three most high conviction views? What do you have strongest beliefs in at this point, Dave?
my highest conviction views would be that we are seeing, at least, when it comes to the drop in the dollar, we're seeing emerging countries actually, starting to strengthen. I think that's a positive sign for the emerging markets, which have underperformed the U.S. markets for over 12 years, and dramatically. I mean, there is no foreign country that has the upside that we have had. They're extremely cheap. And again, you can look at China and say, I don't want that, but there's other countries to choose from. So I do believe that the U.S. leadership as a whole, in terms of the indexes, are shifting towards the emerging markets. And then it's, pick your spots and the ones you trust. I hear from everyone, just as George, you have said, you don't want China. Well, that's fine. cross that one off your list. I'm fine with that. But this is what the trends are showing. I
So
can't
okay,
change them. I can
right.
get
So
a wider
right, so
marker. Right?
you like emerge EEM will outperform. What else? Just thought. I mean, I don't want to put words in your
Yeah.
mouth, but lie to that. I have to think. Does that also mean that, for instance, the dollar is going down, gold is going up? I mean, what other thoughts do you have that go with that?
Well, when you look at the materials sector, as I said, you're getting a lot of the basic metals are bottoming. And I think that's bullish. I see a huge trend to onshoring when you look at the engineering and construction companies. You look at the fabricators of steel, those that make specialized steel, whether it's can I mention names, George? Is that all right?
Oh,
Steel
yeah.
Dynamics.
Dave.
Yeah.
You can mention this anytime you want. I was just trying to give you a wider
Yeah.
berth. You don't want to get specific. Go ahead. Go ahead and mention
Yeah,
it.
so you're seeing this big shift to onshoring, and onshoring is going to happen at any cost. It's in talking to some steel people that entered the room yesterday in one of the spaces that I was on. You're hearing that iron ore is creeping up, but not at the same magnitude that you're seeing the steel fabricators like Commercial Metals, Steel Dynamics. If you look at MCore, Fluor, and NVEE, they are reflecting that firms are starting to engineer and construct very large industrial complexes. I think that's taking place in offshoring, whether it's going to India or Mexico. Um, I don't track all of that. I know that China has put $20 billion into Mexico in the last 20 years. And I think it's like 62% of that is in the last 2 years to get around tariffs. Because if they can import from Mexico without having the tariffs that the administration, Trump and or Biden, has put in place, you're starting to see that money is flowing into areas of the country or the world globally with much cheaper energy prices. So, I think that's a global shift that we're seeing. And that's, again, I think I've always, alluded to this in my career that, the U.S. is an imperialist country, but not imperialism by taking over a country, but instead going in using financial imperialism. And we see that in terms of dollar lending, euro dollar lending. And what we do is we try to find the country that can make the product the cheapest. We did it to Japan in the 70s and 80s. We did it to China, 2000 to 2020. And now we're seeing that shift out of China because of the relationship that we're having.
So EM, you think the U.S. is going to underperform? Let's just keep it real tight here so we can get some questions in. Just thoughts on 3 questions. 1, the dollar. 2, gold. 3, what would you stay away from? What would you short?
Yeah, I think if we get a significant decline in the equity markets right now, you may see dollar become the safe haven asset for a trade. And I think that the U.S. dollar is peaked. I think we're heading down. Gold, silver, throughout my career, I've been a bull and bear on gold and silver and precious metals. There's a time to do it and there's a time not to. And I would say that those are structurally absolutely bullish. And I think that confirms the U.S. dollar is going to decline. And again, I'm not withstanding that, there's going to be a short-term move perhaps in the dollar to the upside just to scare everyone that's bullish in precious metals right now. Because, yeah, I think technicians are certainly in that camp by far, over anyone else. What was your last question, George?
Yeah, what I mean, you have likes, you have don't likes. Like, what would you tell people to stay away from to avoid? Like what is leadership on what's on your sell list? What's on your sell list or short list or avoid list?
Well, I'm not bullish crypto. I'm bearish, perhaps more of the large cap.
So
Tech,
large cap tech, FANG, all that kind of crap you'd stay away from.
Yeah, yes, okay. I would say stay away
from.
So
do you think a portfolio broadly diversified of sort of the EM that you like, plus throw in some the base metals stocks and some gold? I'm just thinking about high Sharpe ratio trade. So let's say we're long the EM that Nicoski likes. We're long some of the base metals. We're long some gold. And we're short FANG against that. You think that's a winning trade for 2023?
I would say that's the winning trade for the first 6 months.
Got it. All right.
And then we'll look through, what I mean, there are, believe it or not, there are tech companies that do look good. So, in this, as I always say, it's not a stock market, it's a market of stocks, and finding those
100%.
companies that are outperforming their peer group, and relative strength to me is what I do. And I can look at a chart of Nvidia versus LSCC, for instance. LSCC looks bullish, like you wouldn't even know a bear
Yeah, no,
market is
no, no,
taking
exactly.
place.
So when you look at the FANG names, just cover them up. If no one
Y-
told you what they were. They
Yeah,
just, I mean,
yeah,
when you, like, for instance, you look at the electric car company that should not be named. Bearish to you?
bearish.
Okay. How,
Absolutely.
how, how, how about that phone company, which is 7% of the cell phone company, which is 7% of the S&P? How does that look to you?
That one I don't like. I think it isn't. I believe Apple is worth like 480 names of the S&P 500. I
Yeah,
mean,
I think
just
it's worth. I think it's worth
combined.
twice. I think it's still worth like twice the energy sector, or some crazy number
Yeah.
like that.
So
All right.
it's
So and Dave, last, I want you to stay on stage, but I just want people to hear names. Dave, do you have a product for retail investors that won't break the bank?
yes, we do, and we can discuss what those products are. You can go to our website vermillioncap.com. And put in your name and your contact info, and we'll get a hold of you and discuss like what your needs may be, and we can package something out of
Yeah,
what we do.
because Dave, I mean, just for those that know him, I mean, Vermilion, they service a lot of the biggest institutions in the world. Guys pay some serious money, tens of thousands, $100,000 for the product. But Dave has a product can help investors of all sizes, and Dave, I think there's a real need for your services amongst the individual investors. So it's great that you're in these spaces, and I urge everyone to reach out to Dave and take a trial of his service. I've known Dave for, I don't know, 25 years or thereabouts, and for absolutely first rate. So Dave, please stay up there. There's some others who've been patiently waiting, wanting to get in here. I'm sure you'll get some questions. Okay, so we're going to do an order here. We're going to do my friend Baron, and then Philip, and then Andrew. Baron, good to see you, man. I know you've been waiting patiently. Please unmute yourself, Baron.
Good morning, transitioning. Good afternoon, everybody. I just have one thing to say. It's my little input on the what's going to cause banks some stress. I believe at least one of the things, and that's going to be what we discussed, which is the implosion of the SPACs and all these zombie companies, which are obviously not cash flow positive and struggling to stay alive right now as stocks squeeze them out. Some of these companies are already getting squeezed out. Obviously, Carvana, CarMax, Vroom. I can just go down the list, and these are just the big names that we know about. I think this is going to be our tidal wave, and the water is just receding. That's all I got to say right now.
Yeah, Baron. I mean, there's that I'd file that under the more general heading of I want you to riff on this a little bit, Baron. File that away to the more general heading of just misallocation of capital, and whether it's SPACs particularly or it's private equity. I mean, gee, lever up a company into a recession with floating interest rates, 5x levered. What could
I've
possibly
got a
go
whole,
wrong? What could
I've got a
possibly go?
whole list of things.
Yeah, I know. I
You and
know.
I talked
So,
about.
yeah. So, Baron, hold on. I want you to go for it. Let's get away from just SPACs. It's much bigger than SPACs. SPACs, private equity, real estate. I mean, just go down the list. So, have a go at it, Baron. I know you're similarly inclined as I am. So, floor is yours. Go for it, Baron.
It's something's going to be the trigger. As FTX was the trigger to crypto collapse, something's going to be the trigger to this. Whether it's the commercial real estate combined with SPACs imploding. Once the news starts getting out about all of that, the megas are already weak. The megas are going to start coming down, as others have said in the room here. Amazon's notably and honestly said, even Bezos came out ahead of time warning everybody that they're doing bad. They're the only company out there not fluffing the books right now, and their P ratio is going to come down. And there's other information that provides for that, but it's just going to be a tidal wave. I believe it's just going to be I hate to come in here like a doom and gloom, but with this, but it is a reality check that something is there, and the Fed's padding the market for this. It's coming anytime in the next few weeks, let's say 8 weeks.
Yeah. So, Baron, do you life is not linear. Nothing goes in a straight line up or down. But do you think this counter trend rally we've seen since mid-October can extend, or do you think it's done?
we are exchanging contracts right now, so they're gonna play some manipulation, drop it down, sell it off briefly to 38.50-ish, whatever, and then pop it back up for Fed Chair Powell, where they then run it green if they want to on the day, as they have been lately, and then drop it the following day, and then we're going back down for that negative 20%. We're following the downward channel. There's no doubt about it. I fought this over the year, following the TA, et cetera, but we are respecting it in every way, shape, and form. Whatever the news is, whatever the excuse is, you can't argue that fact. We're all going to get to the mindset that we're following this channel. That's the soft landing. We're going up, we're going down, we're going up, we're going down. And the narrative is just whatever excuse they come out with.
Right. So do you think so the chart pattern, the tidal wave liquidity going out, you think all the other stuff is noise? Like we're basically the sucker's going down. That's your big picture view. So the upside, I don't put words in your mouth, I'm just trying to understand you. So from a risk reward basis from here, a little bit up and a lot of down. Is that kind of the way you're looking at it?
A lot of down. It's going to chop back and forth into the earnings recession and collapse of these companies. And
And
I think
again,
I think Powell's going to let the market do the work for him initially with softer rates, but it's not a narrative of ever increasing rates anymore. It's a narrative is the destruction's there, and we're rolling into the recession. We're going from inflation to recession, and now things are going to change where the dollar may drop, and people are going to say, "Oh, well, dollar's dropping, stocks should go up, but stocks should go down with it."
so not trying to hold you to a date or a price, but just trying to put a little bit of context here on this order of magnitude. I don't know, 3 months from now, 6 months from now, let's not go out a year. Nobody knows. Nobody even, I'm not going to ask you next week. Everyone wants to know what's going to happen on Tuesday or Wednesday with CPI and Powell. Nobody knows, right? But as I'm always reminded, what's interesting is not the news, but the reaction to the news. But going out beyond the very short run, I mean, the way I look at it, I have no idea what's going to happen. I mean, my 2 cents, Cleveland Fed's been right. Michael Kramer, he left. Hopefully he'll come back. He's pointed out Cleveland Fed's been right, I think 19 out of the last 21 times. They missed. And Neely, you should weigh in here if you're still here on the CPI number that we had in October. That got messed up because of the way. And Neely, actually, I want you to jump in here. Maybe you have a special insight on this. The reason the CPI number came in low in October, from memory, was because they changed the reset or whatever it was on the healthcare stuff. And without that, it would have been a high number. So that's a one-off. So we're done with that. Andrew, hold on a second. I see you raising your hand. And so if we just dispense with that one-off and we go back to the Cleveland Fed, it's been on the right side of the CPI forecast, 19 out of 21 months. And the sell side cheerleaders with their pom-poms has always been too positive or too low of a number. For choice, you'd expect the number will come in higher or better. I go with the Cleveland Fed. I mean, why not bet on the horse with it's been right 19 out of 21 times? I have no special insight. I'm just going to go with them. And then Powell, as someone said to me, and Baron, we're going to get to you. Powell is someone, and I think Michael Kramer wrote about this just last night or this morning, is, he's got to, you look at what a lot of the Fed governors are saying, what the guidance is going to be. Not they're going to jack up rates at a higher pace. It's going to keep higher for longer. That's all. And a lot of the noise coming out of the Fed governors of late, it doesn't make any sense for Powell to talk bullish right here. So I don't really know. But in the for what it's worth category, I don't know the reaction to the news, but that's my guess on the news. And then beyond that, I don't see who's going to stand up and take a risk here between now and year end. But people still have to liquidate some merchandise into a less liquid market. That could get interesting. And Baron, we're coming back to you here. I'm just trying to set you up here. It's T-ball time. So tactically short run. And then we have, volatility bottomed out. The market got rejected as Hakeem Olajuwon, a.k.a. John Roque, from the 200-day, blah, blah, blah. So to me, it all sets up where the rally's basically over. I think Nicoski was just talking about that. Yeah, maybe we wiggle and jiggle for a few days. Who knows? But in the bigger scheme of things, we're going down. So short run, I think we go down. Beyond that, I think, Baron, all the macro stuff you're talking about, we're going down. I don't know, how much, how fast, but I think we got a 3,000 number sometime in the first half on the S&P. 3,000 number. Amy will get to you. 3,000 number sometime in the first half of next year. So Baron, I'm going to shut up. I just wanted to tee it up for you. So my stream of consciousness is minimal upside, significant downside. I think 3,000 S&P is very doable in the first half of 2023. What do you think, Baron?
Definitely. first couple weeks of February are going to be a very, very, very deep zone, if not sooner. If something else, black swan type of thing happens, and we don't call it black swan, we can call it a mini black swan because they're using. But the reality is that all these margins have been kept up through earnings for this past earnings. They barely they missed. So many companies missed or they fluffed their books, and it was clear if you listen to earnings calls how they did it. So they gained in places they shouldn't have gained, et cetera. But they've had Black Friday sales since the summer, back to back to back to back. They're not running out of product yet. They're going to run out of product, but they're running out of consumers. Consumers aren't buying the goods anymore, so they can keep discounting. But now consumers are like, well, we've got everything we need. We're fat. We don't want anything anymore. Now their money is going somewhere else. So as we've talked before, if you just look
Yeah.
at what the banks are doing, the banks are trying to lock up money right now. They're offering high
Right.
interest rates, lock it up for 90 days, 120 days, six months. People are putting their money in there and they're in promotions where they're getting, let's just say, 4 to 6% over the next, quarter interest on that money. People aren't going to pull that out, and it's not liquid, so they can pull it out to buy stocks, even if the market goes down. I believe a lot of money is going to be tied up. People are going to say it's safe. I don't feel comfortable. We're going to have an earnings recession like we've been planning, expecting. It's coming right now. It's going to start, and that's going to be the windfall. And I think the Fed's going to win on that because all the way down
Yeah.
to that 2875 to 3300.
Yeah.
We'll probably hit 3300 first, and then we're going to lose so much
All right.
confidence.
So
That
I see.
2875 is on
All
the
right.
par.
So you're a bear. That's cool. All right, at least you're clear on that. Maybe right, maybe wrong, but you and I are in an echo chamber together. We're both bearish. Maybe we're wrong. Who the hell knows? Certainly won't be the first time nor the last time. All right. I want to go to Andrew and then Amy. Wait. No, first Neely, talk about the consumer, then Andrew, then Amy, and then Shrub. Neely, you want to weigh in on what Baron would say about the consumer?
Well, I was just going to say about the CPI. You said it earlier. I'm about levels, not rate as well, because that's what the consumer pays. And that all consumer purchases begin with an economic reality. The reality is the level, the dollars, right? Not the rate. So that will continue, whatever Wall Street wants its narrative to be on CPI, the consumer will have a reality check down the road if that continues to be, if that runs counter, right? So that's first and foremost. Second, there was a methodology change, I believe, on health insurance and how they were calculating health insurance in the October report. But, heads up, there's another methodology change coming in January. So when they report in early February, you're going to get yet another significant change in the methodology of CPI.
So Amy, Neely, I want to get it straight. They're going to take it. They're going to take out food, energy, and anything else that's going up to try to make the CPI look good. Is that what they're going to do?
Well, I mean, yeah, and I'll speak about it in a silly way so that people understand very simply, because it's actually pretty complicated and it goes all the way back. For context, we have friends and contacts at the BLS, and so we do talk with them from time to time, to understand better the conversations that go on these methodology changes. So this is coming from a very deep place of nerddom, okay? But going all the way back to last year's CPI weight and update, the BLS actually had a pretty decent internal debate, we understand, because they update how they weight the CPI based on how people consume. But of course, we consumed very weirdly in 2020 versus 2019. It was, we purchased a lot of toilet paper, to speak about it simply, in 2020, and nobody really went to the dentist. Okay. So, if you look at those kind of two different areas, it created like this weirdness in the CPI. When they were reporting it all this last year, they decided to still kind of keep it on that every 2 years dynamic. Heading into this year, what they're saying is like, okay. We usually average it over 2 years of consumption data, which, by the way, would include 2020 and 2021 for this next update. They're like, yeah. You know what we're going to do this time? We're just going to base it on 2021. So how people consumed in 2021 was very goods focused, right? And starting to be a little bit more services, but largely goods focused still, because we were getting vaccinated and returning and stores were reopening, right? And now that's going to be the heftier part of the weight, to keep this simple, as you head into the 2023 numbers. So we are obviously already in a period of bringing down goods consumption. And so it will very likely show the optics of CPI doing
Oh,
better.
so Neely, I have to
Mhm.
weigh in, but you got me so
Yep.
excited. Now you tricked
Yep.
me. So basically, if you take something like Peloton as a poster child for what you're talking about, where they're cutting the price of that like crazy, things like a Peloton where the prices are going to go down, that's going to be upweighted in the freaking index, which is going to make it look less bad than it would be otherwise. Is that what you're saying?
Yes, sir.
Neil, let me ask you a question. For those of us conspiracy theorists, and I'm out of the closet on that. I mean, I think you are, but you're in the closet. You're too normal a person. For those of us that are conspiracy theorists, we'd say they're doing this deliberately just to kind of jam the numbers for all kinds of reasons. They're trying to paint the tape. It's kabuki production, all right? I mean, did they really? Is this just like Roque was talking at the outset? These are people that don't live in the real world. Like, are they doing this to try to scam the system and game the numbers for their own, for obvious advantages? Is it willfully done, or are they just like complete detached, naive nerds, and there's no freaking common sense that's going into what they're doing?
I don't know how to answer that in a way that would probably satisfy many in the room, but I would say this. I have seen the power of groupthink in my career, and I would imagine the loudest voice is the one where people are leading versus perhaps contemplative voices in critical thinking counter narratives. It's very unpopular these days to be against the will and the way of the room. And I believe deeply, and I teach this, as you know, I'm also a professor. I teach the requirement of the 10-man rule in my room. And so when everyone is agreeing in one, I say it's our moral obligation to now argue the other point that's not represented in this room and really walking them through that. I think that there's a lot of lacking of moral bravery that's happening in these conversations. I can't speak specifically to the BLS. My friends who are there, I love them dearly. And I think that individually they're very, very amazing, bright, critical thinkers. So I do not want my comments to reflect on them as individuals, but I think organizations do suffer from groupthink.
So let me ask you this. Okay, so let me ask the question slightly differently. So when you're in the quiet in a setting, friend to friend, you talk to one of these people and you just try your own best Colombo imitation. Gee, what about this? I don't understand. Can you please explain it to me? Blah, blah, blah. And you try to engage them in like a common sense discussion around one of these points. How's that go? How's that blow over?
It's like you and I having a conversation. We're going to be iron sharpening iron. I think that I'm just saying that the dynamic changes when you get into the room, I'm sure. But this is actually one, and this is a little bit of my PSA. Okay. And like I said, I'm a good, calm, critical thinking Christian girl from the Midwest, right? But here's where I would go with this. I use, and I should say we use in our firm, almost exclusively not seasonally adjusted data, and we make our own adjustments to it. Okay. In terms of like we will trend line it, etc. If you question a tiny thing like this methodology shift, you should question times 4,000 how they're doing their seasonal factors. Because there's no way, you could not convince me right here, right now, because I have actually gone down into the bowels of some of these government agencies to have these conversations on their seasonal factors. How in the world have you been able to adjust your seasonalities based on what just happened in this consumer economy? There is no way. It would be like a fact sitting at the end of a golden retriever's tail, wagging wildly. Okay, there is no way there's truth in seasonal adjustments. And so we exclusively use not seasonally adjusted data, and we make sense of that. So if anyone who is a data nerd in here and you care deeply about truth, I would throw all of your seasonal adjusted data out the window and do the work yourself for the truth.
Thanks, Neely. That's awesome. All right, listen,
Could I ask Neely a question, George?
Yeah. So hold on one second. Amy, I was going to get to her. So, Amy, I'm going to let you go first, but hear me out for a second here. It's kind of like I'm balancing a lot of different considerations here. We got Andrew, Phillip, Amy, and Shrub, and I want everyone to talk. So each of you, when you speak, you're going to have multiple chances to speak, but I want to work everyone in the conversation. So, Amy, You can dive in first, then we're going to do Andrew, Philip, and Shrub. But I'm going to ask each of you to, with your initial opening, whatever it is, try to keep it tight so we can walk everyone in and we can keep this thing going. So, Amy, go for it. The floor is yours.
Yeah, just real quick, I wanted to ask Neely a question on what she was saying. So how much of this do you feel like is based? Because I've felt through this whole thing that how people were going to react post COVID, that how their lives were going to change, how they were going to spend, all of that was not really quantifiable. So how much of it is just based on the data real time, right? Like it's not something that you can really, chart or graph or use historical, data on, just because there was no way to really quantify how consumers and people in general were going to react post COVID, how it was going to change people's lives.
Amy, are you asking,
Yeah, I was just asking you how, like, for as far as, truth based, like how much of it is just that they don't know. There was no way to really know.
Yeah. I'll just answer it this way very succinctly. What we've experienced from consumption behavior shift and I don't mean just what we consumed, but actually how we viewed trust whole relationships and families fell apart, right? Like, oh, vaccinated,
Right.
unvaccinated, right? Like, oh, mask, no mask. I mean, there's so many things that changed around the need for assurance and trust in consumption, that I think we're still living out what that truth might be in that trajectory on a go forward basis.
Right.
I have that's for another space for another time, but it absolutely relates to consumption behavior. It isn't just about what we consumed; it's how we trust each other.
Okay, that was my question, and just my comment for you, George, was about the Fed. The thing that I'm kind of focusing on is after Powell's little speech 2 weeks ago. When was it that he spoke? The bond market started pricing in Fed funds rate under 5%. So I'm kind of paying attention to what he's saying going forward, and because I still don't think we end the year. I mean, I don't know. That's the part that I'm kind of focusing on, because I feel like the bond market's getting it wrong. So I just wanted to see what everybody's thought on that was. But that was really my only comment.
So, yes. So, Amy,
raising it.
When you say bond market getting wrong, you think yield should be higher? Is that what you're saying, Amy?
Yeah, I think that the bond market's pricing in a Fed funds rate under 5%, and I don't think that's guaranteed.
Yeah, I would agree with you on that. I mentioned on Friday, and I mentioned again this morning, I guess it's not investment advice, but I did short some bonds on Friday because just listening through Vincent Deluard's presentation yet again on why inflation is going to be higher for longer, 10-year at 350 just makes no sense to me. But Amy, let me ask you a more general question, which doesn't rely just on your interpretation of the Fed per se, but you have a pretty good nose for things. What's your feeling about the markets more generally, or what do you have high conviction on? We've had this pretty significant counter-trend rally since the mid-October lows. Do you think we're more or less done with that, or do you think it extends further, or maybe you don't have a strong market call, you have strong views on certain sectors? Like, what are your convictions right now, Amy?
Well, we're coming into one of the worst weeks for seasonality. Just in talking about seasonality, coming up this week, right? So we've got. Yes, I think that the up and away part of the rally is over. I think we've got tax loss harvesting. We've got the worst week for seasonality. So I don't foresee like a large drop. I think they're gonna raise 50 basis points, and it's gonna all come in line with what we already know. But I don't think we're gonna see considerable upside from here. So I actually closed all my positions on Friday just because we're coming into this,
right
week. So I'm not in anything at the moment, but I'm just kind of watching to see how this week goes. We've got FOMC and then, seasonality, the worst week of the year. So it should be interesting. I'm not bullish. How about that?
Yes.
I'm not overly bearish at either.
Yes. Amy, if you try to get ahead of the Fed or ahead of Jerome Powell, looking at what he said the last couple of times, and even more importantly, how the markets reacted to what he said, And again, this is stupid. This is fool's errand to even ask us to answer this question. But I apologize for asking. But I got to try just because I respect you so much. You have such a good nose for things. What do you think in terms of the impression he wants to leave? Forget about the statement. Yeah, it'll probably be 50, whatever. But as we've seen the last few times, the action's always been in the comments afterwards, is how they're interpreted, and they must have some idea of what the impact's going to be of what they say. So if you're Powell, given that the market's rallied as much as it has, you think he's okay with that, or do you think, and given that the Fed's not going to speak again for a few weeks, I guess, and given the market's up so much, as I think I retweeted out earlier today or yesterday, the market's basically completely undone all the tightening that there was. Financial conditions are as easy now as they were back in June. So if you're Powell, do you think you want to lead the crowd more hawkishly, or just stand aside and say kind of nothing, be neutralish, and let the crowd run where it wants with it? Like, where do you think his head is at? Where do you think he wants to lean coming out of this whole thing?
I do think he's going to be a little bit more neutral, especially because we have voting members coming off of FOMC. They're changing over. Kashkari's coming on. Bullard's coming off. So I think he is going to just kind of finish out the year just the way he was at his speech 2 weeks ago when he spoke. And that's just going to be it.
And do you think the market does anything with it, or no strong conviction around that?
I don't think there's much strong conviction going into the end of the year. I mean, even amongst the bulls, right? I mean, I think everybody's just going to try to glide through to January and see what the earnings are going to be. Like Barron was saying, like everybody's waiting for that earnings crash, rightfully so.
Got it. Makes sense. That's great, Amy. All right, so we got Andrew, Philip, and Shrub. So Andrew, floor is yours. Please keep it tight. We will let you have a follow-up, but I want to keep working people in here. Andrew, good to see you. What's up?
Great
What's up,
spaces, great spaces, George. I love the Neely accents, and I'm crazy enough to have some family in Minnesota myself. John, what John said, I'm on board with everything he said, and I think we muddle along a little longer until the second half, and then I have a target of like 3150 on the S&P. But I'm seeing some real cracks. The regional bank weakness, REITs last week with SLG and Welltower. That those were some shots from the bow, in my viewpoint. And then energy is scaring me, even though I'm looking for value in the space. So I see some areas of concern. And then I loved your restaurant comparisons. I used to have this Asian takeout place on 79th and First that I used to take out from them all the time. And then one day I walked by and their rating dropped from A to C, and I never went back. The next time I walked by, they were closed shop. So the risk happens quickly.
Thanks, Andrew. Much appreciated. Let's go to Philip, and then we got Shrub. Philip, please unmute yourself. The floor is yours.
Thanks, George. Great space. Anytime I see John Roque on, I've got to stop what I'm doing and get on your spaces. So, listen, I've been kind of in the queue for a while. I want to make just a quick comment. I agree with you 100% on China. For me, totally uninvestable. But I think, when you look at the broader geopolitical background, and if you read about Xi's ascension and his really, really hardline political beliefs, I mean, we're at war with China, and you can see it with Apple moving production to India. I think that's going to accelerate. And if you want to trade China, I don't see an issue with that. But over the longer term, that's where I think there's massive geopolitical risk. So, and we could have a whole space on just China, right? And you look at the semiconductor, controls that the U.S. is putting in place, absolutely unprecedented, right? So the other comment I want to make before I get to a question for John and perhaps Neely is, if you look back at when Powell started to raise rates, he started with 75 bips. I haven't gone through the trouble of doing the work, but mentally I've noted, the Fed chair people, the various presidents from around the country. If you look at some of their comments, hawkish versus dovish, my perspective is it has been exceedingly purposeful. And the reason it's purposeful is you've got a hawkish Powell at Jackson Hole, and then you've got dovish Fed presidents purposely attempting to confuse the market. So you've got people going both ways. And the reason is because we can't afford the whole thing to be coming down. And you could look at other, specific things like you guys pointed out Tether a year and a half ago. Well, can you imagine if, the Southern District of New York had hammered Tether, right? Bitcoin would have imploded at whatever it was then, 40 or 50,000, which would have caused all kinds of other things. And so I think what I'm seeing from the Fed is just a consistent foaming of the runway. Every time the market starts to go down hard, there are additional dovish comments. And, if nothing else, you got to give the guys credit. They've learned from history how powerful their words are. So I'll leave it at that. But I want to. So my question is fundamentally about housing and the builders, right? So if you listen to the earnings calls from D.R. Horton, Taylor Morrison, Toll Brothers, et cetera, these guys have had unbelievable years, right? It's all very obvious. Record sales, record, in dollars, record sales in units, record gross margins, record profits across the board. So from my vantage point, it's like it doesn't get any better than this, right? It's only going to get worse. And then you look at their their forward guidance is very murky, right? Optimistic and murky. But then if you contrast that, I don't know if anybody on this call heard the Restoration Hardware conference call yesterday. CEO, right? Who is at the mercy of the luxury home market insofar as, their business continuing to grow. And they had, again, Restoration Hardware had record profits across the board, record margins. This guy was unequivocally bare. I mean, he called luxury housing in a free fall, right? And yet their stocks are still levitating, whether it's D.R. Horton, Toll Brothers, et cetera. And so, I want either John or Neely to talk about that, but also the thing that I can't get straight is you see these charts folks are posting online about the $1.5 trillion or thereabouts of excess savings. And I've never seen anybody, and Neely, I'm hoping you can draw some light on this. I haven't seen anybody try to stratify that excess savings by quintile or quartile, because my running hypothesis is that, yeah, maybe the top 2 quintiles are fine, but the bottom 60% of the consumer is going to be in real trouble. And it's that marginal consumer dollar that's going to really drive the economic growth or contraction. And so, you could tie that right back into oil as well and say, well, geez, if 60% of the marginal consumer is in trouble, right, they're spending paycheck to paycheck, their excess savings is depleted or depleting fast, as evidenced by credit card growth. We've seen that go up meaningfully, right? Then oil's got to go down before it goes up. Am I a secular bull in oil? For sure. I see all the things that the talks about relative to, supply, but that doesn't mean we can't have a bear market in oil because the consumer is getting crushed. So I'll stop there.
Great comments, Philip. Neil, you want to go with that?
Yeah, I think first, Philip, thank you so much for your questions here. One thing just to keep in mind, and I've put this in Twitter sphere, so let's remember who Gary Friedman is friends with. Okay, so he's the CEO, right? And I took Restoration Hardware public on the second time around when they went public. So I'm very familiar with the company, the genesis, et cetera. I don't currently cover them, right? But of course, I have muscle memory. And Barry Sternlicht used to be on the board at Restoration Hardware. And Barry Sternlicht has also been in the public domain talking about concerns around the high end and what have you. And if you think about it, what you can probably pretty quickly get to is Starwood, the REIT, right? The Starwood, which is where, Barry Sternlicht, CEO of Starwood. The Starwood REIT, I think, has had a withdrawal freeze recently, similar to a couple others in the REIT land. So I just wonder if perhaps some of that commentary could be coming out of what they're seeing in their own business, for sure. Could it also be coming out of, cocktail conversations among friends? Entirely plausible as well. So I just wanted at least, that's a very easily followable who knows who and who was on whose board and who's friends. That would be a pretty logical assessment I think one could make maybe about where that commentary could be coming from out of Friedman.
Appreciate that, Neely. All right. Powell keeps getting stronger and stronger. So you know what, Shrub, hold up for 1 second. Kantro, if you have something particularly you'd like to weigh in on that question, on that topic, that'd be great. I want to get Shrub up here. He's been waiting patience, but Kantro, I yield to you. Go for it, Kantro.
Yeah. Hey, George, I'll be quick. So just regarding leadership, we often look at relative performance of groups or even the absolute performance of groups like housing or whatever as an indication of, near term or future fundamental trends. And, absolutely anything backward looking on housing looks fantastic, but everything forward looking looks pretty horrible. Given that, it's the bond market that's been whipping around equity markets and therefore equity market leadership. If you look at the ITB index or Lennar, any of those companies, they were all at their lows with the market at its low, and then they all had huge rallies in the summer, and since the lows in October. Those are like the place you want to be if you're really playing the end of a Fed tightening cycle or the end of rising interest rates at a time where the economy's hanging in there still, employment's still okay. So I think to the point about the housing stocks, I think it's just a lot of people piling in there, playing lower rates and having nothing to do with really forward-looking improving fundamentals. And it's a really important nuance because the bond markets never had this much of a grip on the equity market. And so, housing stocks can hang in there as long as rates don't go back up or employment doesn't get worse. And maybe we're in the middle ground between those two things right now. And ultimately, I do think employment gets worse, but there's a limit to how high housing stocks can run up here on the back of lower rates, because eventually rates are going to fall for bad reasons probably. So that's the point I wanted to make, George. Thanks.
Appreciate that, Kantro.
Hey, George, is John Roque still on? Because I'd love to hear his comments on the.
I think he's dropped off.
Oh, no worries. Hey, Nicoski, do you have any perspective on the builders from a short side perspective? On a technical vantage point.
I've gotten a number of spaces over the last week and posted, on Helen Meisler's comment about housing. The amazing things that I would never expect to see, in a bear market is Toll Brothers, D.R. Horton, and Lennar at 10-month relative strength highs. I mean, you would have been better off buying them, at the market lows than the market. And my view is we're definitely in a housing bubble and asset prices crashing there. There's no ifs, ands, or buts about it. Technically they look attractive though. I can't lie. Like, either people are putting enough money down, or the drop in a lot of the commodity structure, such as lumber, which, my neighbor put up a $4,000 or 4,000 square foot house about 3 years ago. The builder called them, probably a year and a half ago and said, hey, that same house would be $50,000 more in lumber. Okay. To give you an idea of the cost savings and with where lumber is, I don't know if these companies are managing to right size the companies or, right sizing it in the decline of housing. I mean, fundamentally, maybe someone can look at them and tell me, but, I have a lot of friends in the building industry that have cut 50% of their staff, and you know what? They're willing to hire if they can get lower cost employees.
Yeah.
So, that's the beauty of the U.S. economy is you can right size a company very quickly, whereas in Europe you cannot. So, and I don't know if that's the truth. I don't know, but like I say, everyone I know in the building industry near me that I know and have great relationships with, companies that build 600 homes a year. That's what I've been told. And a lot of I know, for instance, that there's a development going in just north of Minneapolis. Xcel Energy just sent them a notification that they cannot provide power for that entire development. So I don't know if they don't have the power to provide for that development, or they can't get the parts that they need to put in a 200 house development that was all okayed and approved. So you are seeing, something in the supply chain, or the inability to get permits from the government to provide and produce more power. I don't know what the case is, but that's what
Yeah.
I'm hearing, at least through
So
personal contacts.
based on the conference calls from D.R. Horton, for example, and Taylor Morrison, they have noticed a substantive reduction in foot traffic and marketing, right?
Yep.
And they are reducing their prices. Now, lumber and other material inputs have come down. Labor's come down a little bit. Labor's freed up a little bit. And so they're able to complete homes a little bit quicker than they were during COVID, because that was obviously a problem. But cancellations are way up, like 29% cancellation rate.
Yeah.
So, I keep thinking about a car crash, right? The car hits, a fixed object, or even a slowing, a car going 75 hits a car going 50, and it still takes a couple of seconds for the passenger's head to hit the steering wheel. And that's what I feel like we're in housing. Housing is still great because everybody's looking at last quarter's earnings. But if you skate to where the puck's going, like
I couldn't agree with you more. But technically, I don't like going against something hitting a 10-month relative strength high. I mean, are you safer there than the S&P? That's what I'm looking at. Everything's relative to me.
Yeah, it's a great
if I
point.
get you into a housing market that with the average house going down, let's say it goes down 25%. If I can get you into a housing market that's only gone down 10%, you're feeling like a king, right? And that's but this is not a normal market. This is nothing that we can compare it to in terms of history, what we would expect. Like, I would have expected the high yield bonds to blow out. The high yield has been safer.
Yeah, I totally agree.
Yeah, hold on. We're kind of going off the trail here, right? There's a lot we can talk about here, but kind of the sergeant arms, I got to keep this thing in an order.
Yep.
I want to go to Shrub. I think Kantrowitz got much to say. I got a lot to say, but I want to go to Shrub. He's been waiting patiently. Shrub, good to hear from you.
Hey, George.
Hey, we're on 6-hour time zone change, so
God. Yeah.
we've been out of touch for a while, but I don't know if you want to respond to anything specific, or you just want to. We haven't heard from you lately. You just want to go for 5 minutes on what you're thinking of the world these days.
Yeah, let me just answer a few of those questions. So one of the most important things to watch is the savings in the system. So there's a fantastic book by Galbraith that was recommended actually by the Seawolf Cap. So one common thing with all the bubbles is that high level of savings. And it's actually really, really intuitive if you think about it. Bubbles are created because the average person has excess money, doesn't know what to do with it, and he starts doing stupid things like buying tulips or crypto or stocks. And there's always the charlatan that says we're democratizing finance, so he makes it easy for them to buy all this crap. So the level of savings in the system is very important to just see how the bubble deflates. And the one thing that I've seen some data for this other gentleman was asking if there was a breakdown by quartile of savings. And I've seen some data whereby the lower quartile people have basically used up their excess savings from the pandemic. And also they've started actually leveraging up through the credit cards. So that's why if you see the credit card usage is very high up, because then the average person probably got used to like a better lifestyle or something during the pandemic because of excess savings. So now he's tapping his credit cards, or basically inflation is forcing him to use the credit cards. So the lower quintile people in terms of wealth are pretty screwed at this point. And this is, this is the kind of quartile that you want to track, because that's when the pitchforks come out in reality, right? So that's the point number one. Point number two is the top quartile people, they still have excess savings, and they actually still made a lot of money from the pandemic. And just a very anecdotal evidence, I was speaking with a big yacht broker yesterday, and he said they still have a lot of demand for yachts. So the sale and purchase business is actually doing very well, but it's down 15%. So it's quite bizarre, because people that have serious amount of money are actually putting that money to use, but people that are like kind of just got lucky or something, or had a few good years, they're pulling back. So he said it's the same thing that happened in 09 and 08. Same kind of feel. So if you take this, the savings being very important, then I go back to my favorite indicator. As you know, I track the flows in asset classes, which I think it's, for me, it's one of the core of my process. So I look at the flows in the equity markets. So year to date, we've had the market is down, the S&P is down 17%, bear in mind. The Nasdaq is down 30%, and it's down, I don't know, more than 20. So year to date, we've had 250 billion outflow from bonds. So that correlates well with TLT being down. Bizarrely, we've had commodity outflows of billion. We've only had a money market flows of 19 billion, which is, again, is bizarre, given that rates are, paying you, you're getting paid to have your money there. And then we go to equities, plus 200 billion of inflows. So we're still running. It's the age-old thing that we've been talking since January of this year. The money, 100 billion came into ETFs, and 300 billion left the long only. We still have excess money in the equity market, and the percentage of allocation equities is very, very high. So go back to the same setup we've had in 2000, which I keep repeating, but no one listens really. 2000, the market was down 10%. 2001, the market was down 13%. 2002, the market was down 23%. And if you remember, 2002 was when everyone got killed. So I kind of think we're going to have the same thing here. I think we're going to have, we took the first wave out, we took the retail out. 2023, we probably just chop along and kill people trying to buy breakouts or think it's a new bull market or whatever bullshit. So we probably finish next year down 10, and then 2024 we can finish down 20 for all I know. So again, it's a very painful process, because we're used to sharp movements because of the COVID V-shaped recovery, because of what we've seen in the past. People want a quick resolution, but they will not get a quick resolution because there's still excess liquidity and money in the system. And there was an amazing conversation between you and Michael Howell a few days ago, which everyone should go and listen to, because that was a phenomenal conversation that you're not going to get anywhere else, where he's talking about liquidity. And I actually agree with him, because that liquidity is what's going to make it even more painful to find a bottom, because we know things are overpriced still. We know things are out of whack. So I find pockets of value in some things, but there's some really obvious pockets of overvaluation, right? So, the crazy car company to start with, it's only $500 billion, right? So there are all these bizarre discrepancies that are a result of liquidity, and that will take a while to play out, especially for another added reason that Michael Howell touched upon as well, and I feel I'm on the same page, is the guilt, let's call it the guilt Mageddon, when the UK Treasury lost control of the gilt market. That was a bit of a wake-up call for the other central banks to not blow it up completely and have like a December 18 dislocation. That's why that liquidity is still kind of in the system, and they're still trying to tighten, but managing it a bit. So overall, the setup is basically a very bizarre setup that you will not get a quick resolution. You will not get VIX. I mean, look at the VIX. The VIX is behaving so weirdly. We're like VIX 2022 with things like blowing up left, right, center. So again, that's an example of liquidity in the system. And I think that's what we're going to have in 2023 as well. The other couple of quick points I'll just make. From the technical aspect, you had a great spaces with Weinstein, if you remember, and back then I've been posting once in a while the Nasdaq chart with the 30-week moving average, and that chart made me probably more money than any chart this year. We've had that spaces with Weinstein in, I think maybe it was in February, and the Nasdaq was just touching the 30-week moving average. It failed badly, and then I flagged it again when it went back to touching the 30-week moving average. It was the first week of August, and I flagged it back then. I think I joined you on a spaces and mentioned that as well. That failed badly, and that was like a moneymaker. Shorting the Nasdaq in mid-August was like a massive, massive moneymaker. And lo and behold, if you see what I put in the nest, we're back at the 30-week moving average. So I'm not saying it's going to fail this time. I'm just saying you have a very, very easy marker to see how the market is going to go by just tracking if it closes above and how it behaves around the 30-week moving average. Now, another three things I'm going to say is like the profits of 2023. It's going to be a question of the profits that they've been trending above inflation. So there's this comment they've been saying greedflation. So I'll be watching about greedflation. And one example of governments attacking greedflation is the windfall tax that we've seen in the UK with the oil and gas companies. I think we're going to see other examples of that, governments attacking greedflation. And the other 2-3 points, Europe. So Europe, a couple of months ago, again, I came in bullish Europe. I said that I was long calls on the DAX, and I think I was like the lone voice. And, some people pinged me privately, making fun of me, actually. But that played out very well because people just thought it was going to be, Europe would blow up straight away. Well, right now, actually, Europe, the DAX is in a golden cross bull market above the 200 DMA. And I'm scratching my head because, we're now actually entering a bad winter. All the good news have played out, and the DAX is kind of a bellwether of the global economy. So I think that's like a massive avoid. Europe is a massive, massive avoid right here, especially with the euro bouncing at 105. And lastly, the other thing to be very, very scared about, the TLT is kind of overbought, 3.5%. I think it's kind of risky to be long, although I liked it. I kind of don't like it with the CPI where it is. And the thing that could be the story of 2023 is the credit spreads. They're just way too tight, and the credit spreads could be the shock. Having said that, though, the credit spreads, there's two sectors that are kind of high yieldish that are doing pretty well. The one is energy, although the oil price, got hit. Actually, the energy credit is doing pretty well because they are making money. The second one is banks, and banks usually blow up in this kind of environment, but they're actually doing pretty well because of there's net interest margins are pretty healthy. So those two segments are actually what are helping the credit spreads stay tight. But I would be more careful about the other segments there. And I'll just leave it there, George. Sorry, one more thing, very important thing. Very, very important thing, underestimated. Blackstone REIT blowing up. I spoke to a very big private bank. They had stuffed all their clients with that Blackstone REIT paper. And that's a very important point because that was supposed to be their best performing illiquid / real estate investment. Blackstone had not raised the gates during COVID. And the fact that Blackstone did it, it means everyone is going to fall one by one. Starwood did it now as well. And this is a segment of their discretionary mandates of private banks that actually was supposedly has done well this year, was supposedly up 7% this year. So I would hate to see what their venture capital crap is going to mark in February when the auditors actually come in. So I think there's like a false wealth. There is false wealth sitting right now in the private banks, and that's going to be a rude awakening after the auditors come in.
Shrub, what a masterful survey of the scene. Karen, we'll get to you in 1 second, but Shrub, I want to drill down a little bit further. Starting with the BlackRock. So what? That's all frozen right now. So it's being held at this bogus mark. Do we have any idea when that's going to become liquid and what it might be marked at?
No idea, but imagine when they start actually selling assets. Because if they have to sell assets to meet those redemptions, that's going to be a pretty big hit for markets that are not that liquid anymore. So, to give the example of Germany, Blackstone was the biggest, one of the biggest buyers of residential real estate in Germany. So what? They're going to go now and sell 10,000 units like that? Can't do that. Not with mortgages going up. So it's a classic example of a asset liability duration mismatch. And it's happening to the biggest private pool of capital we've ever seen. So, it used to be these guys, they used to be 10 billion funds, 20 billion funds. Now, how much does Blackstone run? Is it closing into $1 trillion or something?
Yeah,
So,
Blackstone on total is like trillions of dollars.
Yeah, exactly. So basically, it's become where it was supposed to be. It's a classic example. It was supposed to be a niche asset class, and now it's just the dominant asset class. And they misguided investors about what it is.
Rob, just listen to you talk. It kind of runs in perfect parallel fashion with Tiger.
Oh, absolutely.
Absolutely. The private should have been like a side thing. That became half the fucking book.
Absolutely. And I think that's why I mentioned it. I'm going to call it, we need to call it something, the false wealth effect. Because when I spoke to the private banker, this was like one of the biggest private bankers here in Europe.
Shrub, I don't know where, I got to look it up where the name came from. I think it's a good term for that sort of, it's the mark to myth.
The mark to myth. I love that. Yeah.
It's the mark to myth. All right.
Yeah. Mark to myth. But imagine, because the family offices in Europe, about 40% of their assets are in private equity and venture capital. So imagine that these guys, that their liquid portfolio is down 20, 30% this year, but they're saying, but it's okay. Blackstone is up 7%, so we're good. And then once the first guy tries to take it out and that mark is not real, well, immediately you kind of screwed yourself on the other 40% straight away, because
100%.
the committees will be coming out for all these guys, and that's going to happen in February.
Yeah. So Shrub, let me ask you this. I mean, you and I are largely in agreement on all this, but I want to drill down a little further here to something I usually don't do, but I think we're at a delicate point in markets. We've had this nice counter rally off the mid-October lows. John Roque, who was in here earlier, talking about being rejected at the 200-day, 4,100, 4,200, whatever. Volatility's come way down. It's interesting the crap has not led in this rally, which is what you'd expect if this was the real deal. Blah, 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 blah. You have CPI Tuesday, Powell on Wednesday. You may say, George, my opinion, I don't have strong conviction on this, but whether it's this week or not so locally, micro, the next few days, the next few weeks, I mean, my own view is like, I don't know what's going to happen Tuesday, Wednesday. I said earlier, I suspect the CPI number probably, I'll go with the Cleveland Fed. I'll take the over. And then Powell, who the hell knows? But as Stan Weinstein would say, what's important is not the news, but the reaction to the news. So in terms of what you think Powell is more inclined to say or do, lean hawkishly, lean neutrally, lean dovishly, but more importantly, with how the market's going to react to all that, thinking that also who's going to want to stand up and take risk in the calendar. Here we are in mid-December. A lot of places have closed out shop already. This has been an annus horribilis for so many. They just wish the year would be over. And then thinking about how the market's rallied so much over the last 2 months, and I'm unpacking a lot in here. I'm trying to set up the question for you. Do you have a strong view about the market over the next week, month, 2 months?
I have a very strong view, which is I have a non-consensus view.
I have to tease you. You even confused me with your tweet. something about the monkey and the cat, and the monkey's smart. And I read the whole thing, and I'm like, I don't know what the hell the guy's talking about. So maybe you got to explain it.
Oh, I kind of forgot. I use the monkey analysis all the time.
Yeah.
Just because I grew up as a monkey that tried, I tried to evolve into a shrub. Because it's funny. This business, as you know very well, it's a monkey business. And being in a hedge fund, you kind of like, you are a monkey. You're smart, but you're forced to act like a monkey, right? Sometimes you know that as well, right? Sometimes we do things in a fund that we wouldn't do if under other circumstances, because we have investors or we have other mandates. We have a mandate that forces us to do something, and that's why I joke about these things, but in reality, it's the nature of the game. And being a bit of a free agent, I know how the game is played, so I just try to play the game the other side. I try to find the weakness from what the market participants are doing.
100%. So let's focus on that. Maybe zoom out. So we have conviction next week, month, 2 months,
so
3 months.
Here's my conviction. My conviction is, bizarrely, that I think H2 next year is going to be where the real shit show is. And I think H1 could even be choppy for a few months as we fight between bulls and bears and if there's a recession or no recession. And it's a very bizarre thinking, but I have a feeling, because things are not that bad yet, that we keep rates higher. That's why I think the 3.5 on the TLT is a bit of a mistake, because I think things are not that bad yet. And if they keep rates higher, then they really slow the economy. So if we're still debating if there's going to be a recession or not, because it's still a debate between people, then we can have rates higher for the next 3 to 6 months, and the Fed doesn't cut, then H2 could be a real shit show. That's why I use the example of 2000, 2001, 2001, 2002. 2002 was the worst year. So we could have a very bad H2, but H1 could just be choppy around between 3,600 to 4,000, because this is my other two conspiracy theories. I think there's a Fed short call at 4,000. So I think the Fed doesn't really want the market to be above 4,000 for much. So they're short a call. We are short a call, actually, because the market is such a big part of wealth and the economy right now that a higher market actually loosens financial conditions, as we've seen now. So they don't want the market to be much above 4,000. But equally, at 3,600, you see them every time. They're kind of coming in to calm the market a bit. So it's like a mini put. I wouldn't call it a put. I'm just going to say it's a mini put. And that mini put was more because of the bond market blowing up, which now there's more liquidity in the bond market, because I don't think they want to have a gilt type event. I think that's what they care more about, that the S&P being at 3,600. So as soon as they fix that or calm it down a bit, I think they're not going to care about the 3,600 mini put. Now, the other thing I'm going to say is about Powell, because Powell is a lawyer and an ex-private equity guy, I think Powell wants to tighten enough. So I joke about this statement. Here's the statement I'm going to joke with. Powell wants to tighten enough that Apollo's distressed fund can buy juicy distressed bonds at good yields. But he doesn't want to tighten that much that Apollo's real estate funds blow up. Does that make sense?
Shrub, you explain it now. I got to be honest with you, since I love you, man. I read that like 5 times backwards and forwards the other night, even after a few glasses of wine. And I couldn't understand it because of the way you wrote it. The way you explain it makes perfect sense.
Yeah. So that's how I think. When I hear the guy speak, I think about it this way. It's like he's speaking with his buddies on the golf course or whatever he goes. And it's like, guys, you're going to be buying yields at 15%. You're going to buy distressed bonds at 15%. And they're going to be like, yeah, rubbing their hands. But he doesn't want to go to the golf course and see his real estate, Apollo real estate guy saying, Dude, J-Pow, you blew me up, you motherfucker.
So, Shrub, with that in mind, so I agree with all that. But given that the market's run the last couple of months, and like you, I think the bond yields don't belong here; they belong higher. And given that the market's up, it's drifted up to close to 4,000, wherever we are, 39, whatever. I mean, and given where we are on the calendar, again, it's atypical for me. I'm going to ask you an unusually short-term focused question. Between what's likely to happen this week with the CPI number and what Powell is or isn't going to say, but more importantly, the reaction to those events, and given where the calendar and people, I don't think anyone's going to want to stand and take a risk right now. What do you think for the next few weeks?
I think there's no one with chips that can take risk right now. So if the CPI, let me put it this way, because right now I see a lot of value on the relative value. Like I see cheap stuff and expensive stuff. So if I'm going to say it this way, is this: what would make me take off my longs? If the CPI comes out just a whiff, I think you can see like a December 18 type scenario. And December 18 was very nasty. So given the setup, and again, with the NASDAQ touching the 30-week moving average, man, if it's a bad print, it's going to be a very bad December. But equally, let's think about it this way. By the way, I'm not positioned for this, just to be clear. So right now, my positioning is I'm long and short. I find I have longs that I like and I have shorts that I like, which for me is a bit rare. Like usually I'm pretty directional. This time I'm like, I don't like the car company. I like whatever, right? And you can long Disney or short Netflix or whatever. But this type of setup, oh my God, it's so bad. And what's bad about it, think about it this way, George. What's bad is that people don't have chips to react accordingly for the last week. So that's why it can dislocate properly. But even worse, I think what's worse than having a bad ending for December, the real pain trade is to have a bad start for January. Because let's just say that people write off 2022 and say, you know what, we're not going to get paid in 2022, but we can start 2023 fresh. So imagine they come in 2023 and get a slap in the face.
Shrub.
So I think there's more painful because I'm like me, when I come in sometimes, because I'm a bit Machiavellian maybe sometimes, I try to think what's the biggest pain trade. And actually that's a bigger pain trade than a bad ending for 2022. Because 2022 is shit already, right? Market's down 30%. 2023, 2022. So 2023, you want to have a clean start. If you start with January down 5 or 10, sayonara.
Well, Shrub, you want to go with the ultimate pain trade. We're just bullshitting each other. But take the sucker down hard. By the way, I love the way you framed this. There's no one has risk chips to play with here, defend it if it goes down. So take it down. There's no one to defend it. And then also a bad 23. And honestly, I agree with you. If there's a 4,000 call and a 3,600 put, we're closer to the top than we are to the bottom of that. And so
as simple as that. Yeah.
Yeah. And so I'm leaning short. I'm negative. People can see the ETF. I mean, if you put a gun to my head, if I put a gun to your head and said, red or black, up or down, what do you think?
Oh, down.
Down. Okay, that's what I was looking for.
Yeah.
That's brilliant. Hey, Kantro, you want to jump in here, mix it up with Shrub? Kantro, are you there?
Yeah. Hey, George. I wanted to circle back to the housing point, but if you don't want to, I got a couple things I wanted to say that kind of bring it back to the high level for macro.
Go for it. And I'm sure Shrub will have some comments on that too.
Yeah,
go for it,
and I 1,000% agree with what Shrub was talking about, how the second half of the year is going to be the worst part. As technicians would say, that's what the charts are showing. Every single macro leading indicator is still pointing pretty much straight down for leading economic indicators, which means earnings revisions throughout most of next year. And so that means that the worst of earnings, the worst of things like the ISM and other PMIs is probably not going to be until the the late part of 2022. So that in other words, fundamentals would be at their worst, if not continuing to get worse towards the end of next year. So that's totally in line with what Shrub was saying. 1,000% agree. And what he said before that, where it's going to be kind of a potential for a back and forth right now, because there's two problems. We have a bond bear market and a coming earnings downturn, and right now we're kind of in between the two. and there's enough for both sides to debate both of those factors. So that's what the market's going to be between that tug of war. So 1,000% agree with that. On housing, just to go back to the conversation we were having and what Dave Nicoski was saying, I agree in many ways. We've never seen this type of backdrop before. And that's history is sometimes has these exogenous shocks. History does rhyme. But I still stand by that. There's parts of the cycle that always repeat, not rhyme. And that's, how housing acts as a kind of a barometer of the future of the economy. And so right now, housing stocks, I think that there are parallels you can look back. And I would say, look at housing stocks in June of 2006. They rallied like 30, 40, 50% in the last 6 months of 2006, right ahead of the worst housing crash, in fact, in history. And so why did housing stocks rip in June 2006 through basically February 2007? Because the Fed was done. And why are housing stocks ripping up 20% since October? Because people think the Fed is done. So I see a very strong parallel there. And you can even go back to 2000. Housing stocks bottomed after rates rising in May of 2000, and then went up for basically the whole recession because we were in the middle of the housing bubble. Why did the housing stocks rip? Because the Fed was done. So that is repeating, and that's why housing stocks have done well now. So again, there's definitely evidence of parallels there. On average, 70% of every stock is a function of macro. And right now, macro is bond yields. And so that's what's going on with housing and a lot of other stuff. And George, I sent you a text message because I'm trying not to post too much until the end of the year of ARC and ITB. And directionally, from January till the October lows in the market, directionally, they've been the exact same trade. And
100%.
That's the connection. That's macro, right? There's nothing that Kathy Wood
Right.
stocks
So,
in housing.
Kantrowitz, if I tell you, if I'm taking responsibility for the bond call, tactical, and I'm with Shrub, and I think bond yields are going up, bond prices are going down, I own that. I put it into the Piper Cantro macro, web simulator thing you got. If I put in higher bond prices, higher bond yields, lower prices for $50 in double jeopardy, what does that spit out for Kathy and ITB?
They're both going to be under immense pressure. And the thing is, look at, and so I said they've been the same trade directionally since October. Since October, housing stocks are up 20% and Kathy Wood's up nothing. So what is that? That's the 30% difference in fundamentals, right? Housing stocks fundamentals are great. The other ARC has no fundamentals effectively. So, or you can look at Microsoft and ITB, which directionally, just using Microsoft as just a poster growth stock or, whatever you want to call it. But that stock's rallied because it's got good fundamentals. Forget about where it's going. And I'm not trying to make a comment on Microsoft, but Microsoft is not ARC. And so, again, a massive divergence based off fundamentals. So real simply, the pattern is you buy housing stocks when the Fed is done, and that's a trade. If we're heading to a recession, it is a new bull market in housing stocks if it's a soft landing. So again, I think housing stocks are a great barometer of what the market is pricing in for the odds of a soft landing. Right now, it's saying the odds are pretty good. And so you buy housing stocks when the Fed's done and when the economy bottoms. So even if this is a short-term trade for the end of the Fed and hope for a soft landing, again, if you're right on yields, yeah, that's done. Or if I'm right on jobs down the road, that trade's also done. Even when rates come back down, when do you sell housing stocks? 2 times: when rates rip and when claims rip. We've had rates rip. Right now, the market's debating where it's going from here. Claims are not ripping yet, so housing stocks are hanging in there. So again, I think it kind of, that group is uniquely positioned to help us kind of understand what the market's thinking about the economic outlook.
So, Kantrowitz, that's brilliant. I want to ask you a follow-up, and I want Shrub first, Kantrowitz, and then Shrub. Same question. So, and Kantrowitz, you started to talk. I can't remember if it was in this space or when you dropped in on Friday. But it's great to hear from you again. Not too early to start thinking about 24. And also, just thinking, you triggered me when we talking about the housing stock. So if we're in there's a cycle, but there's multiple things going on. There's a cycle, but there's also the regime shift coming out of the biggest anomaly with respect to liquidity, monetary policy, and interest rates in 5,000 years. And so if we say, okay, yeah, economy goes into recession, ceteris paribus, rates come off, blah, blah, blah. That's true. But what's also true is, Dorothy, we ain't going back to Kansas anymore. No more 60 basis points on the 10-year for you. So let's just say in a world, and so let's say coming out of all this, you know what? Inflation's 4. I'm just making up a number. I just want to frame the conversation, not give you the inputs. You can put whatever lipstick you want on this pig. But let's say we come out of this inflation at 3-4, not 2, not Weimar, 3-4, maybe 5. Who knows? Some number like that. So yeah, rates come off cyclically for all the reasons you're alluding to. But again, going back to history, rhyming up or repeating, we've got a step change function as we're coming out of this, aberrational, completely anomalous regime that we've been in. So that serves to militate against the decline in rates. And so that maybe the 10-year 350 is not such a great bargain. The rates maybe come off a little bit, but they don't come off all that much. And so most importantly, coming out of all this, you talk about cycles and reflating. You so ably, remind us what happened in the last cycles. If there isn't tons of more excess liquidity for the market coming out of this because of the inflation, and there's limited scope for fiscal, I mean, talk to me about what an L-shaped future might look like and what it might portend for the market going forward. Because markets are forward-looking, and so if we don't have, if we're not looking forward to more reckless fiscal expansion or reckless monetary expansion, we could argue whether the market, bottoms at 3,600 or 3,300 or whatever. But I want to get to the concept of time. And what does it look like the morning after? First you, Cantro, and then Shrub.
Well, in time, yeah, again, with what Shrub was saying, that I agree that things are going to be worse. The worse we get into 2023, the worse the fundamentals are going to get. Whatever we call it, a hard landing, a soft landing, a mild slowdown, whatever it is, and this is the debate, but I think the positioning call is really about, is the data going to continue to get worse? Not as much how bad will the data get, but how long will it continue to get worse? So I agree with time. The problem with a soft landing, and kind of talk about the question you asked me in context of a soft landing versus a recession. The problem with a soft landing is you don't get rates down that much. You're not going to get much stimulus to help the economy rebound because it's only a soft landing, and you're not going to really create much creative disruption. So a lot of the crap that's in the market right now in the economy is just going to still be there. And that's going to be a drag, as it's been since the GFC, on future productivity gains and malinvestment and all that stuff. So that the soft landing is not exactly, that's more of an L-shaped recovery, where inflation stays high, and eventually I think that will cause a recession. It's just a longer landing more than a soft landing, because until you crush employment, we're going to have high inflation for a while, 4 or 5%. I agree. If we have a recession, then you get more stimulus, you get a bounce in housing that's more material to help flow through the economy in 2024, and then you're quickly back to where being afraid about reflationary problems much faster. So it could be a nice sharp reflationary rebound in financial assets and commodities, in particular in interest rates, but then we've got the same problem very quickly right in front of us, and that's going to be the unique backdrop compared to the last 15, 20 years, whereas we recovered sharply and didn't have a big tightening cycle right in front of us like we had in 2020, like we have today, or had in 2021. So that's, I think it's going to be, a volatile period for equities. The simple way to say it, I think we're going to have really weak returns going forward for the next several years if inflation remains sticky, because multiples are going to go down very early in a recovery. So even if earnings do pick up, and especially if they pick up more as a function of pricing power than unit growth, investors are going to discount that via lower multiples. So you're not going to get a dollar of earnings. It won't give you a dollar of returns. It won't be bank 1 for 1. It'll be a fraction of that, which is kind of what we saw in the 2002 to 2007 period on steroids, because commodities were the leading part of the economy basically, and so that's kind of the way to think about it. And then the last thing I'll say is that goes, I think it only reinforces the point you and I have talked about a lot about, where do I go in growth? Where do I go in value? You stay away from the tails, because we're not going back, hopefully, the last 15 years where junky long duration growth can just go up at any price. We're not going back to the 80s and 90s where you had the great moderation kick in. That gave you a nice, great backdrop for risk on and deep value for a long period of time. The answer, I think, is somewhere in the middle. And so just good old fundamentals. which is good for active managers.
Yeah,
but bad for passive.
yeah. Cantor, don't you think we're also entering an age of golden age for active management?
1,000%. Yeah, I think the last 15 years has been the worst environment for active managers in probably history because, in a growth market, those markets tend to be very cap heavy, biased, and very narrow. And it's hard to beat the S&P when 7 stocks, are explaining half the returns. The easier market for active managers is one usually where smaller caps or basically breadth or equal cap is beating large cap, which is what we had for much of the 80s and 90s. So I don't think we're going all the way back there, but somewhere in the middle. So definitely something better. And if we're going to have this very more cyclical market with more frequent pullbacks, then passive money is going to get spooked out quite often.
Hey, George, I've got a follow up for maybe Shrub.
Philip, if you don't mind, I want Shrub to go, and then you'll go after Shrub. Philip,
no problem.
Yeah, Shrub, the floor is yours.
Yeah, Cantro nailed it. I think, look, the key word is we should be expecting weak returns going forward. That is a key word because, again, here's how we think about it. What problem did we start with? What did we start with? We started with the most overvalued bubble of all times, not only in equities, but also in credit. Remember, we had $10 trillion of negative yielding debt. So we started with a big problem. That's how we start with. And a big problem takes a while to fix. That's why, again, it's going to be a pancake. Some things are going to look like a pancake, just flat for years. And, I was a portfolio manager in Europe. And frankly, Europe was like that for years after the GFC. And I think people should be prepared for something similar. We started with something overvalued. There's still liquidity in the system. Unemployment is still very low, which delays the resolution of asset prices. So it's good that unemployment is low because, we don't have social unrest and people have food on the table. But it also slows down the eventual resolution of fair asset prices. That's why, for example, there's a car company that on average, I think I was reading that it's a 10% position on average for US retail investors. So that car company is a 10% position because these people have a job and they have a portfolio, which under a deep recession, they wouldn't have a portfolio. So that thing is going to stay. It's going to take a while to resolve. And I think the less exciting the market becomes, the more we drift down as we get rid of all these people that want excitement. And that's how it was in 2000 as well, if you remember. So as the excitement fizzles out, we come with a resolution in 2002 that everything blows up. And at that point, we were saved by China as well, having a massive stimulus. Whereas right now, we look at China and their earnings. What is it? The price to earnings of a house is like 50 times, whereas it should be 10. So that's not going to save us this time. So slow resolution, slow and painful. We got to get used to it. On the active managers, I'm very excited. Even now, just simple things. The stuff trading at 10 times earnings and other things trading at 50 times earnings. The discrepancy is the biggest ever. So if people have some patience, then it's actually a pretty good way to make money in a sideways market, I think.
Shrub, I couldn't agree with you more. It's the return of fundamentals. No more narrative-driven liquidity nonsense. I got to be careful what I say here. Shrub, I'm talking to you, man, so listen to me carefully. So if there was an ETF out there that was short that car company that shall not be named, would you tell that ETF manager he should cover that position or stay short?
No. Look, I have that discussion. I run a family office, and I have a certain position that I defend with
Hey, Shrub. I want to go back to a conversation you and I.
But let me just tell you something else. George. It's a position that I have personally that I am not touching, and I force myself to not look at because it's so obvious.
I know. I know. Shrub, I want to go back to a conversation you and I had about 6 months ago. We were uncontrollably laughing. Remember the one I'm talking about? Who was
Of
going to
course,
buy the
yeah,
bonds? Okay. So that was spot on. So
absolutely.
it's deja vu all over again. Who's going to buy the bonds right here, Shrub? Right here, right now.
Well, look, that's the problem, and the problem is that the U.S. is going to start. They're going to issue another $1 trillion for their fiscal plans. So that's why it becomes a very tough trade. 3.5%. The banks are not buying. I think the only thing that can save it a bit is if the Fed and the Treasury game the system and give kind of incentives for the banks to buy treasuries. That's the only thing that kind of bails it out. But otherwise, China's not buying. I mean, Russia's never going to buy again. Interestingly, by the way, just one thing actually that was very, very interesting to note. The Saudis, so Xi flew over to Saudi Arabia, shook hands, importantly, right? Remember Biden did a fist bump. No, Xi actually shook hands with MBS. And they signed a deal to buy oil in yuan. So again, that limits demand for dollar and treasuries.
100%. So Shrub, real quickly, stream of consciousness. Any thoughts? And it's fine to say I have no strong view. I want to ask you about the dollar, gold, and oil.
Okay, so dollar, I think it's topped out. I think we saw the highs for the cycle, but I think it's probably going to bounce from here if it makes sense. So I don't think we're going to see the highs again, but it probably oversold. That's one. Oil, I think it's a surprising in some ways here. I'm not that surprised because I have my own conspiracy theory that the Chinese have teamed up with OPEC for a good reopening. I'm not surprised, but oil should be, look, for this cycle, 70 to 90, I think is the right price. So it's at the low end. I actually have some calls on oil and gold. I am the lone punter that bought puts. I would never short gold outright. I think gold should do well, but I actually have puts personally on gold because if it turns, if TLT turns, if the bonds turn, gold is it can get smashed if this turns. So on gold, I have a very strange position. I basically think gold is a structural long in many ways, but I have puts because I think if one scenario plays out, I'm going to make a lot of money. If it makes sense.
Yeah, no, that makes sense. Do you think, by the way, coming back on energy, so you say energy range 70, 90 on the commodity. What do you make of the energy stocks here, Shrub?
I think they're in a void still. I issued a warning on a tweet a few weeks ago. I thought they were very overbought. I think certain segments are bottoming out. Maybe the energy services are probably bottoming out. I think the equities themselves have a bit more to play out. Just to, it was for a very simple reason, by the way, because they've done very well this year. It's a very easy source for people to just lock in some profits. If you have a 5-year view, of course you just keep them. So I'm a short-term trader. So on a 1 month view, I'll probably get a good entry, I guess. So I would be looking to buy soon, but I'm kind of patient. The one thing I don't like about oil stocks, by the way, personally, is I don't like what happened in the UK, and I think what happened in the UK is going to be repeated in other parts of the world. They're just an easy source of funding for the government. Yeah,
sure. I'm just coming on the oil. Last question on oil. How much of the decline? I've read a lot of stuff. I'm sure it's the same thing you read. It's been just a lot of financial speculators, hedge fund guys, liquidating longs. I think I saw the open interest a few days ago. It said it went down by like 190 million barrels for 3 weeks. So how much of it's fundamental weakness and how much of it's just decline in demand for paper oil?
I think it's a lot of paper oil. I think it's one very simple reason why I wasn't involved in it personally, and why. I mean, I was telling people to get out the last few weeks. It was a very obvious long for people. So, why is it an obvious long? SPR finishing, China reopening. So everyone was positioned for that event. And I think there was a lot of speculative money in this. So now it's okay. So now this SPR is finished, but it's finished in a weakening economy, and China supposedly reopened, but it didn't really, right? So people have played a reopening, but it's not a real reopening. It's going to happen in 3 months or something. So that paper oil, I think, just got obliterated in reality. And whereas the real demand and the real shortage is probably like 6 months away. And then we're going to have a real, I mean, you've had many spaces on the topic. Structurally, forget about my short-term nonsense. Structurally, I mean, there's a very, very big problem in the oil space. I mean, to the upside, structurally. I mean, I'm a structural bull on the oil side. I mean, that can get very ugly in the next few years.
Right. So, by the way, I just want to set the record straight here, just so everyone's on the same page. And Shrub, you can probably speak to this, but like you, I've been a structural bull on oil. Was very positive the first half of the year. I sent out a tweet earlier this morning. It seems to have stirred up a hornet's nest, but this is a little bit further afield. But Shrub, this is a serious question for you. Seriously, I want your help on this because, Twitter, it's very easy to have a misunderstanding with people. And it's just god awful. I mean,
Hello.
I think we lost George.
Oh yeah, I'm here.
I think we lost George. Hey, Shrub.
Hold on. No, I'm back.
Oh, sorry. That's all right.
Sorry. So Shrub, you know how when you see a Twitter mob and when everyone's on one side, usually tactically, I'm not talking structurally, tactically, it's a good contrary indicator. You should go the other way. And so I put a tweet out, just commenting on how, I think I was focusing on
Wait,
oil.
so what's the question?
And I was like, I was saying when people are, Shrub, can you guys hear me, by the way? Is this kind of messing up? Hello? Philip, can you hear me?
Yeah, it sounds good, George. No.
Okay, sorry.
Yeah, we can hear you.
Okay, so to anybody on stage, so we can clear up any misunderstanding, but it's also a useful tool, I believe. Whenever you see a Twitter mob, I would actually use Twitter mob as a substitute for market sentiment. And we know what we're talking about, okay? Whether people are too bulled up on energy, or they're too bulled up on crypto, or they're too bulled up on the bearish position. I'll raise my hand on that one, all right? It can be structurally right, but when it reaches a crescendo, when it becomes a huge mob, and everyone's trying to outdo each other, I'm more bearish than you are, or my price target on ARK is lower than yours. Or you have guys saying oil's going to 100, 150, 200. Or you have crypto bros saying Bitcoin's going to 100,000, 200,000. I'm not talking about over the long run. I'm talking about if you were to focus at any point in time where it just gets too crowded to one side. I usually view that as a pretty good trading tactical fade it go the other way type of suggestion. And I see Shrub left, so I'm going to ask anyone else who's on stage, whether it's Cantro, Nicoski, Neely, Philip, Barron, Shrub. Here he's back. I want Shrub to answer this question. Shrub, the use when you see Twitter mobs, does that speak to you when you see a Twitter mob, Shrub?
Yeah, look, I think it's we have to be grateful to them because when they get too loud, they usually present a great opportunity to go the other way. I think it's as simple as that. Unfortunately, whether it's ARK fanboys or Tesla fanboys or oil, it's the same thing. When people get too loud, it's usually just a sign to get out.
Yeah,
George.
And to anyone who's listening, that's all my comment was intended to make. It wasn't anything more about I hate oil. As a matter of fact, I'm very bullish on it longer term. It's just not here right now. So people sometimes get butthurt when someone says something opposing their positions, but it was not meant personally, and it certainly wasn't meant strategically. So that's all I was trying to say. Can I make a very
simple comment, George?
Yeah, go for it.
Because people ask me about the flows all the time. So it's very simple with the stock prices. It's actually a very simple job. When people get too loud about an investment, The reason why it works the other way is like you should ask yourself who's going to be the marginal buyer. So if the last guy on Twitter is bullish on oil, like who's going to buy the oil position from him? You think it's going to be BlackRock, who has an ESG constraint for the next 10 years? So it's kind of easy actually.
Yeah, no, that well said. Philip, Philip, the floor is yours. Philip, please speak up.
Thanks, George. Listen, I'll just make a comment on this, right? So, someone I respect a lot, this was probably, I don't know, maybe 6 months ago, put on a pretty big position in Facebook around 215 or something like that after it had come down from 300. And, this is a value investor, if you will, that, had all the accolades of the, profitability of Facebook, et cetera. And so, but I think what people miss, and this is something I learned from Stan and from your spaces, George, is when we're in a secular bear market, right? You cannot behave like Buffett. Will Facebook rebound to $500 a share someday in the future? Perhaps, but you don't have the liquidity to put even 1,000 shares into Facebook at 215. And what's Facebook at now? $150 a share or something, in that range. And so I think people, get caught up in, oh my God, it's down. And you talked about this earlier, George, right? What's a stock that's down, 80% and another 50% from there, right? So, the crowd mentality, I think people have to step back and look at the bigger picture. And I forget who said it before, but macro is moving a huge part of the market. And so if you're just looking at fundamentals, it might be a great company, and that's why I'm looking at housing, trying to short them. But I see massive downside. So my question for Shrub on flows and passive, right, specifically is, has anyone done work on what happens when we flip the calendar year? So you've got all your high net worth, or frankly, people making even 100, 150 grand a year that are maxing out their 401ks that get maxed out, perhaps in Q1 or early part of Q2. So they're not contributing to that passive for the back half of the year, and then it restarts January 1. So I'm just curious, could we see a bounce in equities because passive flows have a substantive, bounce just in terms of the magnitude?
Yeah, I mean, Michael Green, who's on the audience, I mean, he's the best guy to follow around this topic. I just follow the weekly flows into asset class, and last week was the 7th biggest outflow on record for Lipper data, so that's the kind of stuff I look at. But the 401ks, I think Michael Green would agree. I think I've listened to him on the topic. It's unemployment is what drives those flows lower at the end of the day, or the boomers retiring, which is another important point. So
I guess
it's too big picture for me, whereas I just track weekly stuff.
Yeah, my running thesis is that most of those jobs at the high end, right, we're back to the inequality and the excess savings, right? Most of those jobs at the high end are going to be retained, or even if you got laid off from Facebook, you're going to go get another job. Those people will be out of work for a month or two at most, and so you're going to have this potentially bounce in the market, right? And so if Mike Green's on, I'd love to hear any comments he might have on just the magnitude of those flows at the beginning of the year.
We're going to go to Cantro, but before Cantro speaks, I'm going to front run Cantro. I'm going to channel my inner Cantro, and that is, you get, I think, what is 100? I remember seeing some nonsense somewhere along the way. Over 100% of the net flows for the year come in the month of January. Okay, fine. So all things being equal, expect the market to bounce. Hello, Captain Obvious. What I think is more interesting, though, is not is the market going to bounce, but what's going to bounce. And Cantro was saying earlier, like I could see, okay, you get money come in, you don't know what's going to happen in the world's a risky place, blah, blah, blah. So a la Cantro, you stay between the 30-yard lines. You buy reasonable companies, decent valuations, decent fundamentals, decent cash flows, no crazy stuff. No ARC, no home run ball, would-be bankrupt airline companies with Magumbo levered balance sheets, blah, 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 blah. And apropos of that, what I finds really interesting is you look at the price actions Cantro was saying earlier, the garbage is, and we can get Nicoski back in here, Roque has left, it's below the 200-day moving average, and it's not moving. So you look at ARC, it's within a few percent of its lows for the year. Tesla was like at a new low for the year a week ago. Oops, I shouldn't have said the name of the company. The crap. I mean, I can't imagine someone walking in. Shrub, don't laugh too hard. You got to say keep yourself muted. Someone coming in on January 2nd and saying, oh, it's a new year. Let's set the clock back to zero. I'm going to buy some AMC, some Carvana, and some Tesla. And some ARK. I just don't think it's going to work that way. I think if people, the lesson shall be presented until learned. People learning about risk. If they got to put money to work, I think they're going to buy in real companies. All right, Kantrowitz, the floor is yours.
I'd love if Mike Green can come up, because I'm not as definitely familiar about the early seasonal flows in January coming from 401k. But not most people can't, and correct me if I'm wrong, but most people can't fill up their whole annual 401k deposit in the first quarter of the year. I'm assuming people that are doing that are only those that get sizable bonuses, that are making a sizable salary, that have the ability to do that, which is not most people. And even so let's just take those people that are doing that. Are they going to put it all into equities, A? And B, are they going to put it all into passive funds, even if they do put into equities? And the money, if not, where does that money go? Treasuries or active managers in equities? And our active managers are just going to dump it into the market or be more selective. And that's kind of goes to what George was saying. What are you going to buy? I don't know too many active managers I think it was Shrub who said this, who have a lot of, even coming into the 2023, that really want to take on a massive amount of risk. Sure, there's people that are bullish, but that's definitely not the consensus.
No, I can't try. I'll show. I agree with them. You want about real companies that strong cash flows, good balance sheet, aren't dependent on external capital, don't have earnings volatility. You don't want sex, drugs, and rock and roll in your portfolio. You want boring. And the other thing I would say, and Michael Green's a friend, but honestly, I got to say this flat out: those focusing on flows did not prevent you from getting fucking run over. Oops, I cursed. In 2022, flows is not the whole game. All right, it's a question of where it goes. If you kept looking at the flows, you would have stayed in the market the entire time and gotten destroyed in 2022. So I would not stand there worshiping at the altar of flows. Just say, oh, the money's going to come in January. The market's going to do well. How many times, Shrub, this is for you, have we seen a crappy January? All right. So I'm not saying it's going to be a crappy January. I will say this. I think ARKy type, Tesla type garbage is going to do very poorly in January. Shrub, Kantrowitz, thoughts?
Go ahead, Shrub.
Shrub, we can't hear you. Shrub, we lost you in the matrix. Kantrowitz, you want to speak up?
Yeah, just be quick. So we've done a lot of studies on seasonality, whether it's January, fourth quarter, Santa Claus rally, or sell and may go away. And, the data is all out there. And so everyone's pretty familiar with what the aggregates look like. But if you parse that data by periods where earnings estimates are trending lower, which is the backdrop we have today, versus periods where earnings estimates are trending higher, which is periods when the economy is reaccelerating, you get a stark difference. So basically, sell and may go away. Stocks go up when the economy is accelerating. Think of 2021, think of 2009, think of 2016, or any year where PMIs were going up from the low, middle, low 40s or high 50s. So when the economy is accelerating, all that stuff kind of doesn't really work as well. And then periods where the economy is decelerating or earnings are slowing, like we have today, sell and may go away works even better. In other words, stocks rarely go up, even worse than the overall averages. And the January effect, which is kind of like a small cap value effect, which has kind of gone away over the years. A lot of that had to do with flows and stuff, but and people kind of have arbitraged that out to some extent. That also, again, just doesn't play when you're in these more macro extreme environments. These seasonal things tend not to happen. And I know you could say, well, look, the market just rallied, in October and November. I'm not so sure if, sure some of that was seasonal and chasing markets and, not wanting to end the year behind the benchmark. But let's also face it, what happened in October were some massive things. The UK problem went away. The BOJ intervened. We got some good CPI data finally. So, there were a lot of events that certainly explain why the market's done what it's done the last 2 months. So I just be careful with seasonals when you're in such a powerful tail macro environment, which I think we're in right now.
That's great. Hey, Shrub, are you still in the matrix? You guys speaking up again, Shrub?
I'm here. Yeah, I'm here.
Oh, yeah, we couldn't hear you. Sorry, we couldn't hear anything.
Yeah, sorry, I'm having sound issues. Look, I think it's to Kantro's point. if things go well, people put money. If things go bad, they take out the money. If things are not doing well, they're going to take out the money. It's just that simple.
Fair enough. All right, everyone stay up there. I want to go to David and then Baron. David, good to see you. What's up, David?
How's it going, George? Thank you for hosting this wonderful space. And I think to Cantrow's point, considering the gilt market and specifically quick interactions to go back to QE, specifically to support the pension outflows or pension gilt system in that sense, my big question would be, one, how much is the stock compensation taxation report coming into play within, let's say, the end of Q4 and the beginning of Q1 specifically, and the ideas of a increased stock compensation outflow in redemptions from these individuals, and then two, considering that we have more ETF inflows, 500 billion of inflows, despite like grim year this was from the Financial Times. I think that it's conducive to a apathy that's been created within the pension, or I should say passive investor in that sense, almost the Walter Deemer idea, very apathetic, and we haven't seen much, how can I say, understandings of let's say the wealth effect that's been created and the loss of wealth, especially if we're looking at the funds. Apologies for my lucid thoughts there.
No, David, just coming back to the stock-based compensation, there are many angles to that topic. What part of that? What nuance of stock-based compensation?
This is out of ignorance, right? How much does Q4 end of year play into the taxations and how corporations necessarily interact within their tax and their accounting in the development of stock compensation, and why we see a disjunction between December and January, specifically the beginning of Q1?
So I don't have any insight into that. Maybe Shrub or Kantrowitz do. But I'll just say one thing about stock-based compensation, period, and that is that's becoming and will continue to be an increasing target of scrutiny when you're looking at companies. It's a perfect reflexive Rube Goldbergian perpetual money machine thing. When number go up, companies use it and abuse it. And now that number not go up, the tide's going out, they're going to have a problem. So if you just do a simple screen of the worst offenders, and Jim Chanos has done a great job of this, identifying companies where stock-based compensation is the highest percentage of revenue or income, it's mind-boggling. And I would talk, those companies have been doing horribly, and I suspect they're going to continue to do horribly. Shrub, do you have any thoughts on the stock-based compensation?
Yeah, actually, let's tie it up to the previous question because I have a more solid answer now that we have the SBC topic on. So who's going to put money in the markets? So I discussed the bad prints, what do you call it? The mark to myth of Blackstone. So if Blackstone REIT is marked to myth, then the venture capital funds are marked to fraud almost, right? On a scale of mark to myth, venture capital is probably marked to fraud. So when those marks come out, because these are Cathy type stocks, and the venture capital funds have the real marks again when the auditors go through them in February, March, then Cathy type stocks could do very, very badly. So that's step one. Step two is these Cathy type stocks, they do rely on SBC to exist. And with a very simple example, say there's a 10 billion company that paid out $1 billion in compensation in SBC. Well, if that stock is down to $1 billion market cap, what's it going to do this year? You think it's going to issue $1 billion of stock? And what's going to happen to those employees? They're all down. So basically, this is a negative feedback loop sector. The Ponzi sector is a negative feedback loop sector. So it all comes up together, and this is a grind to zero for these stocks. Actually, these stocks is not going to be a grind to zero. This could be a fast zero. So that's why the SBC, with stock prices low, they accelerate the demise of the company. I mean, you're going to see companies like Carvana going to Chapter 11, which otherwise it could have just printed more stock for creditors and employees. So I'd be very, very, very careful with that, and also with people calling lows in Ponzi type stocks.
So Shrub, you just talked about Carvana filing Chapter 11. So let's just talk for 30 seconds about the second order effects of that happening. Like, how many cars does Carvana own? And by the way, they've been buying them at a premium for the entire year. when those used cars hit the Manheim circuit and used car prices crash, it's going to take down new car prices as well. You couple
Yeah, but
that with
that's bullish
housing.
because CPI. No, but man, CPI is going to come down, and that's bullish, isn't it?
Well, so listen, you can
I'm
have,
joking. I'm
yeah,
joking.
yeah, yeah. So, but you get it. I just, the constellation
But
of
this is. But let's
things
stay on
that
this
are
point because
happening.
it's a very important point because this is how people are going to get destroyed next year. You have a market that is bad, the car market, right? The used car market. So they're going to see, and seeing used car prices go down is very bearish for the sector. But the monkeys, let's go with the monkeys analogy. They're going to see the CPI come down. They're going to plug it in their models, and they're going to be dancing on CNBC that CPI went down from 5 to 4 because the Mannheim index collapsed, which actually is kind of bearish. But this,
Yeah.
the market could be up 5% on that day. So,
Yep. So, hey, the other piece of anecdotal info I'll share with you guys. So I live in a mid-tier city in New York. A buddy of mine's friend owns the largest towing company, and he does only repossessions for 3 of the big mid-tier cities in New York. He's up over 300%. He can't repossess enough cars because he doesn't have enough drivers. So just think about that for a minute. He's up 300% on repossessions. No one's talking about that. Look at the used car
Yeah, so
financing market and the delinquencies.
Philip, I have to interrupt you. We tweeted about that months ago. I urge everyone. There's a guy I think is Lucky Leo. I can't remember his name. There's a guy, and I'll retweet it. I tweeted about this 6 months ago.
Yeah, 100%, George.
Yeah, okay. And he tweeted about this. He drove around showing all the lots, telling people what was going to happen. This was like back in July. So it's all there. It's happening. And used car prices, in November, down 14% in 1 month. I think it's the biggest 1 month decline ever. No surprise there. They're going a lot lower. Plus, you know what you're talking about? I'm going to pour gasoline on that fire, no pun intended. You look, and I'll retweet some of this stuff. The size of the average payment now on a car. Oh my God, the guy's paying like $1,000, $1,500 for an F-150 truck. With 10,000 down. I mean, this is complete insanity. And then you ally to that the fact that you're getting bottlenecks being resolved. New car production, which has been constrained for the last few years for all the reasons we know, is starting to pick up. And so you're going to see the whole market flip upside down with used car prices tanking. And so, no, I couldn't agree more. Excellent point, Philip. All right, I want to go to Stephen. And David, do you have a quick follow-up? Then to Stephen. David, keep it quick, and then we're going to do Stephen.
Very quickly, considering that Carvana is a good case study and representing a company that's held by majority of ETFs and other index funds, how is it dangerous for these indexes holding certain companies like Carvana, just using Carvana as this illustrative bad company with bad capitalization that could be a illustration of other companies in these indexes, and leaning on Michael Green's work, essentially, how competitive is the stock market? This is Valentin Haddad's one of his references, in the sense that the passive inflows creates a consolidative nature to volatility. And I think Shrub brings up a very interesting idea that we haven't seen max volatility. And in this idea, sorry for making it this longer than it needed to be, but the inflows of these indexes in consideration to consolidation of volatility is at play. Would you agree with this idea?
I'm sorry, Dave. What's the question?
The idea would be, would you agree that the inflows of passive capital is consolidating volatility, and we haven't seen true volatility within the market?
100%. And that's the top's gonna come off that one. Dave, you want to answer that, Dave Nicoski?
Well, I mean, I can speak from personal experience. Probably 4 years ago, I went into an account that was all RIAs and only trade ETFs. And I said, at some point, this will unwind. Everyone's owning the large cap stocks, but it doesn't mean that all passive ETF structures will be negated. And that is, like, if you looked at like something like coal, the ETF ended in, the middle of, the 19, or 2020. I mean, that would have probably been the hottest ETF if they didn't close it. So, I agree with that assessment completely. I think this whole, view of passive investing is migrating to the active manager. And I think everyone in here has, denoted that, that, the days of passive investing and buying an index is over. I mean, the Dow would be at new highs if we didn't, take out ExxonMobil and add CRM. And then we'd be talking about a bull market in the industrials when the very index industrials doesn't contain industrials anymore. They didn't want the index to die in the back room of, Dow. And so they migrated to a new path where they said, hey, tech is the leadership, right? So, look at histories over time and, studying the S&P 500 from, the 2000 bubble to now, I think there's less than 50% of the constituents still in there. It's an actively managed index. So keep that in mind. Just some forethought.
Thanks for that. Stephen, you've been waiting patiently. Floor is yours.
Yeah, thanks. I just wanted to mention that there's been a lot of talk around equities without, I think, a real recognition that the dynamic between equities and bonds has changed a lot. If you go back a few years, bonds were really giving you 10 to 20% of sort of long-term expected returns. If you expect equity returns, a couple of years, people were saying like 8%. Right? No one who manages money is really a large portfolio of money is expecting higher than that. So now we're in this new regime where instead of low risk bonds giving you 10 to 20% of that return, you're getting more like half, maybe up to like 75%, depending on how much additional credit risk you want to get. So I think more and more private U.S. investors are just going to keep flowing into these safe assets because they get you close to your return. So why not? And it also helps like the U.S. sort of fund its deficit, right? If you sort of look at the old buyers of debt, China, Japan, Europe, those guys are starting to go away or have gone away. So no more QE. Banks don't want to buy treasury because they can actually lend now. So someone needs to buy it. So, I think if equities keep going up, it just gives the Fed more room to raise interest rates. And it's still taking time for the market to really crystallize the fact that bonds are getting people close to their targeted returns. So I don't know if anyone has a different view on that, but I see if equities keep going up, it just means that there's more room to keep raising rates.
100%, Stephen. And it was talked in various. And by the way, this conversation now, it's funny. This went on for 4 hours. I look at this room; it's just been outstanding. Some of you are gluttons for punishment. You've been here for the whole while. We're going to wrap this up pretty soon. I gotta have a life. I got things I got to do. But I was informed. I was told months back, run shorter rooms, too long. But the community here is just unbelievable. I mean, the amount of wisdom here. I've learned so much, and I hope you have as well. So, I know we spoke about this earlier, the fact that really foam the runways, and individuals, yes, the lower end of socioeconomic strata are having a hard time, but not at the high end. The ability to service their debt obligations is extremely high. Company balance sheets are in relatively good shape. I think most observers would have thought at the beginning of the year, when a year ago, the 10-year was, I think, 1.25, 1.5. That if rates went to 2 or 2.5, the world would blow up. Well, here we are at 350, having been as high as 4.25, and the world didn't blow up. And so, as Shrub was talking about, as Kantrowitz was talking about, it may be that it takes a while for the roof to really fall in. That maybe the first half of the year, the economy doesn't go to pieces. It may not be until the second half of the year. So, no, there's scope for rates to go up. I couldn't agree with you more. So, Urs, I want Urs. Urs, you were in a space we had, I remember, a few months ago, and I think you were the senior ranking member of this space. And I remember your comments about what it was like going way back in the day when you were a young man starting your career and what a bear market was really like. So, Urs, I don't know if there's something in particular space, a topic you wish to speak about, or you want to just bring your perspective of what it was like in a real bear market. But I'm really, really delighted that you've were willing to come up on stage and speak. So, Urs, if you'd like to unmute yourself and please speak, we'd love to hear from you, Urs. Urs, the floor is yours.
Yeah, thank you so much. Really appreciate the space. It's a fantastic venue. So I started in the business on April 2nd, 1973. And the thing that I remember the most, and I think, one of the things that people might just not really understand is that the bear market was one thing, because if it's going down, that things, they are going down. There's no reason to buy, but it was very painful the way it went down. And then I actually remember where I sat when I was in Switzerland still, when the market turned in December 1974. And it was an article that I read about Edson Gould that was saying 1975 is going to be a great year because there was never a bear market that ended in the 5. And I thought that was really interesting. Anyway, the market went straight up into 76 and made the top, I think, in 77. But what happened then after that was just agonizing, because if you go back in history and you look at the chart going back from 1978 to 1982, it was just essentially going sideways, up and down, and no real traction with anything. And, you had these big sell-offs in October, I remember, and it was just totally frustrating. And the other thing that I remember is that there was nobody that could mentor you in terms of how the bull market was, because the people that were in the markets before that, so between 1966, the market made a high in February 9, 1966. But the problem was that the market then, it went sideways, and you made a low, I think, in 68, in 70, and then 74. But they also had a very bad experience. And because of that experience, everybody was kind of like so frustrated. And the thing that I just can pass on to you is, it's one thing, we are just so accustomed to the market going up. And I think what is really missing is the frustration factor that the market just might go sideways for a prolonged period of time and do nothing and just frustrate the hell out of everybody. And it's just, it moves away from the front page and nobody cares. Maybe that's a little different now because you have so many people that are in the market. But I remember at that time, nobody really was in the market to speak of. I mean, the public was not there. I remember I suggested in a conference to one of the guys that were running the Swiss TV station that maybe, would be helpful to report what the market was doing. And they were laughing at me and saying, nobody cares. People want to know what the weather is doing, and they want to know what sports team is winning, and that kind of stuff. So it's just something that came to mind. And when I was listening to the space last week, the thing that really stuck out to me is between what's happening with the pension plans in England and what's happening with inflation, so that you are between a rock and a hard place and you have to accommodate whatever really makes the situation worse. That reminds me so much of Arthur Burns in the 70s, when you had that stop and go policy. And if you go back and see what the market was doing between the time Arthur Burns was in charge of the Fed, you will see that the market essentially went sideways from the time he started and the time he left. So that's all I have to share right now.
So, Urs, I'm really intrigued by your comments, particularly the part about time. I mean, is
George?
Sorry, Urs. I muted myself by accident. So I'm really intrigued by your comments. And obviously trying to make predictions is a very difficult business. But what I'm really curious about is not so much what I think the market's going to do, this week, this month, but the bigger picture. And I want Shrub to weigh in on this as well, and Nicoski. But for you first, Urs, the idea of time, that when you have such a big bubble like this, the bigger the bubble, the longer it takes to work out. And, I'm a summa cum laude graduate of the Japanese bull market. I ran an aggressive international stock fund in the 80s. And the remarkable thing about Japan isn't that it went down 80%. The Nikkei peaked at 39,000 and change in the last day of 89. It fell to 7. But here we are, it's 2022, 33 years later, and the Nikkei is only at 27,000. And as someone has said, time kills more people than price. So what I'm more curious about, Urs, is not so much a short-term forecast, nobody knows, but in terms of lessons for you from the past, having seen a big bear market, a big bull market, how many long it takes years takes to repair itself? And you said you see the market going sideways for quite a long time now. I mean, what that says to me is the types of stocks that are going to do well. All this momentum crap, which depends on, ever falling interest rates and increasing liquidity, like that's not going to work. But just grinding people down in a bear market. I mean, what was the psyche like of people? What was the mentality of investors back then? And what do you think if you had to draw from that experience, what do you think the next few years are going to look like?
Well, I cannot even imagine. I mean, I remember the event with Japan I think it made the high in end of December 1989, and I cannot even remember. I mean, I cannot even imagine a bear market like that from Japan. It's just incredible. But, the big difference probably was in 1982 when the market took off, the PE ratio, price to sales, all of these kind of things. We are so much lower than we can even imagine right now because, and then, of course, interest rates were way higher. I was trading bonds on the floor of the Zurich Stock Exchange in that time, and that was an experience by itself because I experienced the big bear market and then the tremendous bull market that came after the Fed turned, and that was just an incredible experience in terms of how desperate people can get and that you cannot sell bonds at all. And they had to kind of stop trading because bonds fell that much on a percentage basis, on a daily basis, that they could not open for trading unless they were recovering a bit. And on the other way, when the market went up, just how different it was in terms of the anxiety on the floor of how people were trading. The thing that really stands out to me, though, is that now you have so many more participants in the market, and it became much more that people are involved in so many levels, and day trading at that time was just simply impossible because the commissions just wouldn't allow anything like that. I mean, you just couldn't pay for that, and you didn't have the infrastructure. That was just not possible to do. So I think the concept of time that, you are just being stuck and there's just nothing to do, that is the one thing that is just so ingrained in me, how painful it was in terms of no traction. And now, when I look at what happened in the last, decades that I have been around here in the States, it became such a different situation in terms of, technology stocks and how far the market can go up and just how much excitement can go into the market. And at that time, there was just nobody there.
Yes, or stay with that. The fact that you had the technology, the social media, the gamification with the stock market, the incredible amounts of leverage. I'm putting words in your mouth. I'm obviously, I don't mean to bias you, but just the way I look. I listen to you and I say to myself, look how much worse it's this time. The valuations are far more extreme. And Nicoski, you're the market historian. Shrub, you got to speak up too. Look at how more extreme the valuations are, the level of public participation, the gamification of the stock market, the leverage, the social media. To me, I mean, isn't this a lot worse than we saw than the environment you're talking about in the 70s?
Well, it's much worse because so many people are involved. When I was growing up and talking to my parents about stocks, that was just, they came from the Depression area. That was just not even an argument. I mean, stocks were for very rich people, and the public was just not involved to the extent that they were involved or are involved now. and you don't have that kind of like appetite that you see now to go back into the market when the market starts to pop. It was just very, very different in terms of how the market behaved. And I think the one big difference also compared to now is that you had an entire generation that already was getting slaughtered the time before. So, from 1966 to 1973, you already had 7 years of non-performing or just going sideways. Whenever the market went up to 1,000, they got hit over the head. And then they sold them off again. And then they came up again and they sold them off again. In 1973, I think the high in the Dow was 1,067. And it looked like, the market might go higher. What the market just turned around and went straight down. And by the way, that also was during the time of the great energy crisis. And I remember in Switzerland, I think once a month, there was no traffic allowed on the highways. Everybody that had a car was not allowed to use the car. I think it was on a Sunday, except for emergency vehicles, a fire engine, police, EMS, that kind of stuff. But I was walking with my girlfriend. Her name was Monica. I still remember that. We were walking from my city to the next bigger city on the highway because nobody was allowed to drive the car anymore. It was just a very different ballgame.
So Neely or Cantro, you had a question or follow-up on that?
I just had Urs, that was beautiful. And just something I've been contemplating is, I think a lot of people don't realize when they look at those prior charts. Remember, I was talking about the rigor, right, of looking at prior charts and what's actually in them, et cetera. The 401k didn't even exist prior to 1978. It didn't have mass adoption, right, until you got well into the 80s. And really, it didn't get wider adoption until you get into kind of the aughts. And so to the point that he's making around, it's worse because there's more people affected. I think about this all the time when we look at these charts. So I really appreciated that. Thank you.
Or you need to come in these space. We're going to do a space just with you because you're just such a wealth of information. The world you're describing is so different from an alien to what we're dealing with right now, and I think it's so instructive. So much can be learned from that. Kantro, I think you had wanted to say something, or Shrub, or Nicoski. Any thoughts, comments, reactions to Urs? Okay, so Urs, just stay right there. Let's go to Gilberto. Gilberto, good to see you, my friend. What's up? Please unmute yourself.
Good to see you, George. I've been hearing this delightful conversation while I was reflecting on, I think, three of the most important points I have heard today. First, the weakness in the banking sector in the footstep of this new FOMC meeting and the CPI report, coinciding with the weakness in the prices of the used cars and houses, which of course depress the balance sheet of the clientele of banks by the day, which of course put pressure in the valuations of the shares of those banks because the credit worthiness of the cohort of their clientele is suffering from what could be even higher cost of their debt. So I would like to point the conversation toward what Kantro was saying about the house, the real estate market, and Philip about the falling and the crashing of the used cars, which of course, what I want the conversation to go through or to guide us is to reflect on how the collateral of the balance sheet of the bank's clientele is really getting awful toward 2023. And Shrub, you say something that I really want you to elaborate, if you can, of course, is that next year in the 2023.
Sorry, I muted you by accident, Gilberto. Please unmute. Everyone, please unmute themselves. I think hello? Can anyone hear me? Hello.
Yeah,
We can hear you. We can hear you,
Yeah,
George.
yeah. I think Gilberto. I think I accidentally muted everybody. So please go back to where you were 10 seconds ago. You were asking Shrub about the collateral on balance sheets. Go ahead, Gilberto. Hello. Did we lose him? Is it me? Philip, can you hear me?
So we couldn't hear Gilberto, but
I can hear you, George.
Yeah, hold on. He's coming back. Gilberto, we lost you. Go ahead. Gilberto, please unmute yourself. Yeah, go ahead. Go ahead.
So just to resume, the negative feedback loop that is happening in the balance sheet of the clientele of the banks, as each day the prices of the assets they hold, which is of course mostly houses and cars, are worsening the liquidity profile of the banking system, and how that connects to what was earlier being discussed, the weakness in the KRE regional banking ETF.
Yeah, look, I don't think we have a banking crisis, so it's not like '08. I think what we have is different. We have a crisis of trust, if you want to call it, because the private bank. If you're a private bank client, okay, let's just do the example. So you have a private bank client. Say he has 100 million in the bank, and he had 50 million with a discretionary mandate of the bank, and out of that they put 10 million in equities, is down 20-30%, 10 million in this Blackstone REIT, and he thought it was up 7%. So what I'm saying is, regardless of his portfolio, the bank is fine. So that's why you have to distinguish that this is not a banking crisis. It's a crisis of confidence that on the mark to myth. So if he thinks he's up 7% on the Blackstone portfolio, and he suddenly realizes that he can't take the money out, and then he starts questioning whether he's up 7%, then obviously he's going to question his venture capital fund, his Tiger venture capital fund, his other venture capital fund, his private equity fund, so all these things, and then he's going to start asking for liquidity. But it also has a big wealth effect for him, because he thought he was worth 100 million, and suddenly he realizes he's not worth 100 million, maybe he's worth 50, and maybe his liquidity is not 50 and it's 10 or nothing. So that's why I think there's a very big problem that has yet to come, as people don't have to see what their wealth is on a real mark to market. And it's a very important point that's not really discussed, because if you ask any family office now, what's your assets, I bet you they would not know what their assets are truly worth right now, or a private client. Of course, the hedge fund is going to know what their NAV is, but a private person that has all these funds, or a family office, I bet you their NAV is going to be wrong, and they will find out their true NAV a few months down the line.
Thanks for that. Gilberto, did that answer the question? Did you have another question, Gilberto?
Well, yeah. The other question I would like to pose to the community is, Michael Howell has been posting these recent liquidity injections that it's been expressing in China for one side, but in the United States as a lower than expected QT unfolding, as less than expected Treasury has been left to roll over. If, for example, next CPI goes in range with expectations and the market rips, how you think will the intention of the refinancing, because let's remember, framing the U.S. economy as economy of refinancing of debt, it's the debt has to be refinanced as it's maturing, and it's really hard to keep this refinancing if rates stay high. So is there any plausible not crash of the equities if next CPI goes in range with what is the liquidity slow the slow pace of the liquidity shrinking of the balance sheet of the Fed?
Yeah, Gilberto. So I'll answer that just because I spent a lot of time talking with Michael, and I mean the gist of it is, they've been draining liquidity. It's only for the first time on a year-on-year basis has the Fed balance sheet gone negative only recently. The pace of QT is supposed to continue at 95 billion a month. In recent months, however, that's been somewhat offset, if not more than offset, by a decline in the TGA account and also the reverse repo. I don't want to get too much into the monetary mechanics because I get a headache and also don't fully understand it. The net of the whole thing is liquidity all in. When you consider the balance sheet, the reserve repo, and the TGA account, it's been a net injection of liquidity, not decline. This was not as expected. It caught Michael by surprise. He spoke about this, as you rightly point out, in the space just the other day. The TGA account is supposed to go down to 700 billion by the end of the year. I think it's like 4 something right now. Who knows if they're going to do it? I mean, they fake left, they go right. There's also a suggestion that that money can be used to fund the government if there's a budget stalemate. Blah blah blah. But the point of it is, as Michael points out, and here's the key thing: when the balance sheet's shrinking, when total Fed injections are going down, when he's being withdrawn, the market goes down. Then you get these sideways movements, like a stair-step function. It goes sideways for a while. When that happens, the market goes sideways or even bounces. So we've been in this period now the last couple of months, which actually gone up. It's supposed to go down. So who knows? I mean, I trust these guys as far as I can throw them. Trust but verify. That's why go to the top of the page, name of the room. The Fed talks the talk and they walk the walk. So far, they're not really walking the walk. Thanks for the question, Gilberto. I want to move on because I want to kind of bring this room to a close. We've been going on for 4 hours and 20 minutes now. And we're going to go to my friend. We got 2 speakers left. We've got Michael, and then we're going to go to 90s random consultant. Michael, the floor is yours. Please unmute yourself. Michael, can you hear me? Please unmute yourself. Okay,
Sure.
90s.
Oh, come on.
Yeah, go for it.
I just love these spaces, George. I can't thank you enough. I thought the Michael Howe thing was absolutely brilliant the other day. And it's a very interesting conundrum we're now at. I read the book, this Bernard Baruch book, My Own Story, and it was fascinating. And one thing that he kept saying in his book was that the breaking of the continuity of bullish thought. And I think it's very interesting and very telling that ARK didn't make a comeback. And, that you would expect it to blow up like with the rest of the stuff, in this latest, what I call a bear market rally. But I don't think liquidity is going to work. It didn't really work in 2007. It was a ground game, Main Street situation. For example, I spoke to mortgage brokers. The mortgage market is frozen right now. As the gentleman mentioned, the repos in autos is up 300%. There's stuck unicorns. It's going to be very interesting. It's like Godzilla versus Mothra. But he made a very compelling argument. I don't agree with him, but he made me think. Let's put it that way.
Thanks for that, Michael. Okay, 90s random consultant. I'm going to recognize you. I know you were messaging me about increasing yields. What's your question, please? 90s.
My question is this. One of the things that I saw just the other day, and my grandfather's been sleepy for a couple of years on these, is all of a sudden he gave a call and said, hey, I found a 5% CD for 12 months on the Gulf Coast. And he was a little surprised to see that number. It was kind of a special, but still it was something surprising. And one of the things I dug into was I can't understand whether or not they're trying to pull that liquidity into some of these smaller credit unions and banks in the Gulf Coast because they need it, or it's because they see that there's this liquidity squeeze coming and they need to have that liquidity as the market progresses downwards. But I wanted to throw that out there to see why all of a sudden has this push been going up in some of these smaller places if they don't need the liquidity. It's odd for them to pay that much if they don't need it.
Yeah, I don't know. Cantro, Shrub, any thoughts? I'll have to think about that 90s. I don't have an answer for you.
Yeah, it was just really weird, and I want to throw it in the room because it's making me wonder if a small bank or credit union on the Gulf Coast is willing to pay that much in yield. Why? Why are they doing that if they don't need the liquidity?
90s, you've been around long enough to know. I suspect it's the case. When things are not obvious, they're not obvious for a reason. Somebody needs some money somewhere. It's kind of funny, given that we've gone through an era the last few years where there was free money for anybody. So kind of makes you wondering. Maybe you're onto something here. All right, before we close this room, I'm going to make my usual impassioned plea to please everyone give generously to World Central Kitchen if you've gotten value from this space. 4 hours and 20 minutes. Cantro, Shrub, Neely, Nicoski, Roque. I mean, so many of you. I can't remember. I can't keep track. I try to keep these things under 2 hours, but we're 4 hours and 20 minutes. You guys made me do it. You're obviously not sticking around because it's a waste of time. So I'm inclined to believe that you have gotten value from this room. So, we've started again to pass the hat for World Central Kitchen. We're almost up to 230,000. We were at 220 like a week or two ago. I want to get us to 300 before the end of the year. This is the giving season. There are a lot of folks there in the Ukraine who are in a horrible situation. Chef Andreas is truly doing God's work. It's incumbent upon all of us to give generously. Some of us in the room, I'm not going to mention names. I don't want to embarrass them, but have given quite a lot of money. Some of them are on stage right now. And so, we have a first world high class problem here, trying to preserve and increase our net worth. The least we can do is give to those who are in real need. So, I mean, honestly, the advice you're getting here is priceless. Institutions pay tens, hundreds of thousands, millions of dollars for this advice. You're all getting it for free. I do this for no personal gain, as do those who give generously of their time on stage right now. So I'm going to retweet out the link to World Central Kitchen. I'd ask everyone to please give generously. There are people out there who are really in a world of hurt and need our help. With that, so again, I'm going to tweet that momentarily. With that, our next room is tomorrow. We have Barry Ritholtz. I think it's at 4 or 4:30 Eastern. People have been saying we need to have more bulls in the room. Okay, so there's a bull. And so I look forward to here. I just retweeted it. I look forward to each of you joining us again tomorrow. Again, please give generously to the World Central Kitchen. Stay safe, and we'll see you until next time. Good night. Good day, everyone. Have a good weekend.